allocating your capital is very important. As I scroll through some of my positions right here, you're going to notice that I have a whole lot of different positions and they are in different sectors. And that's my number one secret. A lot of people blow up their portfolios. They lose a lot of money. That's because they don't understand how to allocate their capital correctly. There are 11 different sectors in the S&P 500. There's information technology, there's healthcare, there's financials, there's consumer discretionary. So consumer discretionary stock, for example, is Starbucks. There are industrials, there's communication services, consumer staples, energy, utilities, real estate, and materials. You get the point. There's a whole lot going on in our economy. In fact, if I go to the S&P 500 right now, I click SPY, you will see that there's a whole breakdown of SPY in terms of what it's holding. So as you can see, technology is a big component of the S&P 500, and that's a good thing for me because I was a technology and a software analyst on Wall Street. I was also doing a lot of consumer analysis. So I was looking at restaurant stocks, and I was looking at different brands, and I have a very good understanding there. But the secret to having good returns without a lot of volatility, and for me, it's pretty clear. Like if I go to my year to date, I'm up 9.29%. Okay, if I go to SPY right now, you will see that year to date, SPY is up 7.5%. So that is Q1. I have locked up Q1 by beating the S&P 500. And just so you know, over a 15-year period, the chances of beating the S&P 500 for fund managers, people with finance degrees, physics degrees, mathematics degrees, the smartest people, quote unquote, the smartest people in the world, right, that are the hungriest for making money, only about 10% of people can actually beat the S&P 500. And these are the best people in the world focusing in the market full time. So clearly beating the market is a very big deal. And a lot of people think that it's very easy, but it's not. If you can beat the market, especially with less volatility, that's the key. Nobody understands this. Everyone thinks about how can I make more money? Well, actually, if you maximize the amount of money that you make per degree of risk that you're taking, that's the actual ratio that you want to go after. It's called the Sharpe ratio. And I always want to maximize my Sharpe ratio. So for example, the S&P 500 here went up 7.5%, but as you can see, it's fairly volatile. If I go to my portfolio, it is a lot less volatile. I am not seeing as big of a detraction when the market goes down, but I'm still getting a good return. In fact, I'm getting more return with less risk. So my Sharpe ratio, hands down, is beating the S&P 500, which means that it's beating probably around 95% of Wall Street. So it's very important for you to listen up and actually look at what I'm teaching you here, because this is really more important than just making a lot of money. Anyone can make a lot of money by just buying call options before earnings. I mean, there's a lot of people doing that and you can make short-term money, but how you actually build wealth is not through short-term action. It's through long-term action. It's through consistency. It's through stability. It's by becoming a very steady trader. And I've always said this, if I can make $100 to $500 a day, I'd rather do that than make $2,000 one day and lose $1,000 the next. Like, sure, you may make more money, but long term, it's a lot more stressful. And in the long term, honestly, just having more consistency is going to be better for your lifestyle. Like for me, I travel and I use money. And a lot of people might ask, like, hey, like if you're hitting an all-time high, why is your portfolio only 2,036,000? That's because, I'm being really transparent with you. I am withdrawing money from my portfolio all the time. I just had to pay my team for my Discord community. And yeah, my team's expensive. So I took out 50K and I took out 35K, to pay all my employees. And for me, I am hitting an all-time high in my portfolio. I had to take some money out for my living expenses and my business as a coach, but I'm being very transparent with you. I'm hitting all-time highs and I can continuously do this for the past 9 years. And most people are not doing this. Most people are just showing you their wins and not showing you their losses. And I think it's super important to be transparent. It's also super important to understand that you need to have asset allocation, okay? This is something that is just not taught to anyone, okay? Most people will not even mention what asset allocation is, okay? But if you have over $100,000, you have to put your assets in buckets, okay? So again, if I go back to S&P 500 ETF, I'm going to tell you what the buckets should look like, okay? And actually, they should look more or less like this. So if you have $100,000, I would put about $25,000 to $30,000 in technology stocks. For me, I am heavily weighted in technology stocks because I understand technology very well. And me personally, I have no healthcare. And that's because when I was working on Wall Street, I was with 9 analysts. So there was 9 analysts in these sectors. And that's because the consumer analyst was both consumer cyclical and consumer defensive. But I had 9 analysts with me, and the only analyst in the office that had a PhD was the healthcare analyst. So she had a PhD in biophysics and biochemistry. And for me, I don't have a degree in that. So I'm not going to pretend to be, Mr. Genius over here, because I'm not. Okay. I have expertise in technology, and I'm going to avoid healthcare. And the fact of the matter is, I think most people invest in healthcare trying to get rich quick with, hey, this healthcare company is going to have an FDA approval. I think it's going to go up. That is really silly in my opinion. You are going to put your hard-earned money in a maybe, that this is going to have a maybe FDA approval? I mean, come on now. FDA approvals can take multiple years, and if you don't have expertise in biology, chemistry, or a hard science, I don't personally think that you should be investing in healthcare unless you're investing in a safe company like Johnson & Johnson, okay? So if you have a lot of money, it is very silly for you, and it's also very bad for option trading to go after these healthcare companies. So, for example, like J&J is going to have very healthy options. They're going to have a lot of option volume. As you can see in the 1 year chart, Johnson & Johnson's currently at 155, and it's very low. It's very low. In fact, and if you look at the dividend yield, it's very good. So this is exactly the type of stock that I would just buy and hold, and that's it. I would just hodl Johnson & Johnson, and I would not invest in single healthcare stocks because they're very risky. I would pick a market leader in healthcare, and I would just say you have 100K. I would just dump 15K. I would do I would start the wheel strategy. To be honest with you, I would go ahead and go to trade J&J options.
Give me 30 seconds so I can show you the trading strategies that allowed me to become a full-time trader and quit my job 2 years ago while also designing the lifestyle I love with less than an hour of work per day. In fact, if you've been trading for at least 3 months and you still aren't profitable, I'm about to tell you why, because I've been trading for 7 years and I know how hard it is to learn to trade the right way. And I've tried everything from moving averages to head and shoulders, support resistance to wedges, and none of this actually works. And even between that and my 9 to 5, the reality of being a full-time trader seemed impossible until I started learning the secrets of how smart money moves the markets. And once I started trading with them, it got a whole lot easier. And that's why I've been able to travel the world and trade full-time for the last 2 years. Because I started trading with the strategies that were proven to work and just copied what the pros were already doing. And I want to give you that same opportunity, which is why I've created The Vault. And The Vault is my free community that now has over 6,000 students in it. And the best part is they're all crushing it. You can see tons of different wins here, and this goes on for pages and pages and pages. Not only are my proven and back-tested strategies inside of here, but also are my 6-figure trading coaches inside as well. They live trade every single week, showing you exactly where to buy and sell. And if that is not enough for you, I've also added in my personal scanners, templates, and tools that allowed me to scale my account past $100,000. I'm giving this away to you for free, so you can only learn to trade the right way, but learn to trade with your 9 to 5, because there's actually a pretty easy way to do it. Now, I want to invite you personally to join the Vault for free, but you have to join now because I'm going to make it paid soon. So if you want to get lifetime access for free to the strategies that allow me to quit my full-time job and trade full-time, click the button below and join now. You're going to see a page that looks like this where you can get for free and get access to my strategies instantly while also have the chance to watch a 6-figure trader trade live in action every single week. So click the button below and I'll see you inside for live trading.
Have you heard about Robinhood? Wait, like the dude in green tights? No, the app, the stock investing app. Yes, but there's so much more than that. Okay, like how? For starters, they have this subscription called Gold. Ooh, sounds fancy. You can earn 5% APY on your idle cash. Okay, let's just pretend I don't know what APY means. So APY stands for annual percentage yield, which is the interest you can earn on money in a bank account over 1 year, which includes the effects of compounding. The higher the APY, the more money you can make. Is 5% good APY? It is one of the best available right now. I do need to start thinking about the kids' future. Do you have an IRA? No, I do not have an IRA. It's never too late to start investing for retirement. And Robinhood Gold gives you a 3% match on contributions into your IRA. I'm signing up for this Robinhood Gold membership right now. Sign up for Robinhood Gold right now and get your first 30 days free. Wait, what? Yup, then you'll be charged a subscription fee. I'm getting gold right now.
Straight up what I would do with 100K right now if I had that in cash. I would go to Johnson & Johnson. I would go out about 30 days. There's nothing wrong, by the way, with going out about 30 days for options. I think it's kind of like a myth that you have to do short-term trading. And in my Discord community, we have a very active group for 0 days to expiration. I think that's fine, especially if you have more capital. If you have 100K, that's fine. You can definitely do SPY trading, and I'll go over that shortly because I'm going to talk about every single strategy that you should have in your portfolio. But the majority of it should honestly be the wheel strategy. For me, I think that folks can retire with a few $100,000 in the wheel, because the wheel is the most consistent passive income strategy. And I love going out 30 days. Nothing wrong with 30 days. You set it and you forget it. You don't touch it. And it's already proven that teachers, just your regular math teacher, your English teacher, writing teachers, whatever, in high school outperform financial professionals. Let me say that one more time. Teachers are better than Wall Street, quote unquote, geniuses with physics degrees. These guys that went to Harvard, Yale, Stanford, and the other Ivy League colleges, UPenn included. So these professionals are not actually having the best of returns. They are just not. They are falling flat and not doing so well, versus teachers who hodl and buy high quality companies are doing much better. So, this really ties into my option trading strategy, which is really around the wheel. So what I would do, for example, is J&J, okay, I'm going to go down 30 days out. I'm going to look for about a 1% return right here. This is perfect. I know 1% might not sound like a lot, but it really does add up. If you can consistently make 1 to 2% a month on a mil, that's fine, right? That's 10 to 20K. Of course, you can make more, because what I'm going to discuss is different strategies, and some other strategies are a bit higher leverage. I will be talking about leverage and margin in this video. But first of all, I would stick to the safest stuff, okay? If you want the most safety, the lowest volatility, they call it variance in finance. They call it variance. The amount of movement you get in a portfolio is variance. I would just sell puts. So on J&J, I would expand this option. The volume isn't huge, actually, which is actually very shocking to me. I would think that Johnson & Johnson would have thousands of volume just like Apple. It may be because this is an unconventional expiration day. Options do expire traditionally on the third Friday of every month. So, let me go to May 19, which would be the traditional expiration day. And now as you can see there's a whole lot more volume. There's a whole lot more open interest. So this is very healthy. The bid-ask spread is, it's not ideal. I want to see a bid-ask spread that is maybe $2, $3, or $4 tight. This is about $12. So it's not ideal when you're basically trading this. You are basically losing about $6. There is a gap of $6, so you're losing $6. And again, this is actually why I don't really love 0 days to expiration trading, because, in theory, even if there is a gap of $2, you're still basically losing about $1. And if you do that every single day, it's $1 a day. I mean, it's not a huge deal, I guess, but in a month, that's $20. That's $240 a year, which is not a lot if you have a bigger portfolio, 100K to a mil, but it certainly can add up to maybe $1,000 in slippage. That's what I want to call it, slippage cost, which is the difference between the bid and ask spread. So even though, let's say you're using Robinhood or Webull or whatever, right? There's so many of these platforms out there. The platform doesn't matter, right? It's just a vehicle to get you to trade, right? Even if you're using a free platform, there is still slippage cost, okay? That's something that people don't think about, which is why I don't really like 0 days to expiration strategies. Now, they can be very profitable, and I do them from time to time, but again, majority of your portfolio should be the safe strategies like the wheel if you have more money. Now, if you have a smaller portfolio, you obviously want to watch my spread video, which was a master video on just spreads, how to scale with spreads. But, with bigger portfolios, you can't do spreads for all of your portfolio. Like if you have $100,000, it is completely silly. Like absolutely, like you're just uneducated if you're going to do $100,000 all in spreads. Like you're completely out of your mind unless you're from a really wealthy family and that 100K doesn't mean anything to you, then sure. But if you're worth, 200K and you have 100K in your portfolio, you would be very wise to be very diversified amongst your option trading strategies and amongst your sectors and even amongst your geography. So what I'm going to talk about in just a second is I'm going to go into my portfolio and show you why I invest in things like Neo, Baba, and recently JD.com. It's because I want to be as diversified as possible because, I'm working with $2 million. That's my lifetime earnings, my net worth, my savings, my everything, right? I can't afford to lose this, which is why I'm focused on consistency. I teach consistency somewhat from a selfish angle, which is that's what I do. And I wouldn't really say it's selfish, but I just want other people to be, similar to me. This is what's important to me is to be consistent. Now, some people might want to be in the casino or the lottery, and I hope I don't attract those type of people. I want to attract people that are saying to themselves, hey, I don't want to work my job. I don't want to have a business forever. I want to rely on a passive income source. I want to do something online where I can travel. I can go where I please, right? So for me, I've been traveling for, 3 years now. But, let's go back to the wheel strategy. I want to sell puts right here at 150. So here's how I manage this position, okay? Because management is super important. A lot of people say, like, when do you get out of a position? And for example, when you do the wheel strategy, let's say you sell a put and then the stock crashes and the stock goes way below, your average cost. Say, you sell this at 150 and say it goes down to 130. Well, you can't really run the wheel strategy. You can't sell 150 covered calls at that point because, well, there's not going to be any money there. They're just so far out of the money. So what do you do in that scenario? Okay, so we're going to talk about scenario analysis and managing your positions. And the first one is really the wheel. So if you sell a put option at 150, you're collecting income. So what I'm going to do is pretty much do nothing until the expiration date. Okay. Now, if this was a large position on margin, then I would roll this put option down. If J&J, for example, went down to 148, 149, anywhere around 150, and I started to get the emotion, because again, trading is not a science. It is also based on intuition, emotions, and experience. So for me, when I start feeling like, and I start seeing both, right? Feeling and seeing that the stock is not in a good momentum, okay? So for example, if I open up Yahoo Finance, let me show you an example of bad momentum, okay? And for me, I like to use RSI. So I like RSI a lot because it gives me a good sense of where the momentum is at, but I can also clearly see the direction of a stock's movement. So as you can see,
try new game Relax Plays and Centipedes for twice the vibes.
Whatever you do it for less at Harbor Freight.
See here, I'm looking at the moving average, okay? So for me, I use 50-day moving average. Now, on Wall Street, I have seen 30-day, I've seen 60-day, I've seen 90 days, okay? I wouldn't say one is better than the other. They're just different. There are different angles. There's different lenses to analyze a stock. But for me, I like to use 50, and that is the default of Yahoo Finance as well. So when I see a stock coming down, for example, here, and it crosses the moving average, that is a sign to me to sell, okay? So I would sell, and this has been a very big part of my strategy. In my Discord, for example, whenever I see a stock cross the moving average, that is a very big sign for me to either buy or sell. I mean, it is a heavy contributor. Now, I would say maybe that's about 20%, maybe even a quarter percentage of my decision. I do look at fundamental analysis, which we will also talk about in this video. But, when I see a stock crossing its moving average, that is a bad sign. As you can see here, this was a very indicative sign of Johnson & Johnson just completely breaking down. I mean, the stock broke down. Now, for one reason or another, fundamentally, there was probably some reasons. There was probably also reasons in the news, right? I mean, it could be announcements, and that's another reason why I don't really love healthcare, is one big announcement could either crash or make the stock go up to the moon, and I don't really like that. I'd rather just have a predictable source of income and not have to kind of like gamble. But still, looking at Johnson & Johnson, it is surprising how much a blue chip company that is super stable, diversified, and is basically all over the world, right? And they're still down a very significant amount. But for me, when it crosses the moving average, that is a sign to get out of the stock, okay? That is a sign for me, okay? But still, right now, what I want to point out is the heavy volume. As you can see here, the little red bar chart thing here is there was a lot of heavy volume. There's a lot of selling. So all the people that were basically not super confident on the stock and started to have a lot of fear, they got out. And again, more fear here. So now we see the stock recovering, and you can see a strong base formed at around 150 per share. So for me, this is a no-brainer. This is a no-brainer trade. I will sell a 150. Now, can it go down to 140? Right? It can, of course, but what I'm going to do in most scenarios is just hold this and then start selling covered calls. Now, what will I do if this stock goes down to 130, which is super unlikely? The chances are, well, let's see what the chances are actually based on options. The chance of it hitting 130 would actually be 3%. So only about 3 out of 100 times would a stock like this completely crash down to 130. But if it did, what would I do? Okay, so what I would do is I would wait until it would recover because I only sell puts on stocks that I want to own to begin with. So if a stock falls down so much that it's now undervalued, like extremely undervalued, as you can see, it would be lower than it's been. Let's go to the 1-year chart. It would be a 52-week low. Let's go to the 2-year chart. Okay, it would be a 2-year low. Okay, so this would be at a 2-year low. I would not actually sell covered calls. I would kind of honestly abandon my wheel strategy because A, I'm not going to get any money for 150. And if you do want to make income on a stock that crashed, you basically have to be okay with selling covered calls below your cost basis. So say I sold a 150 put, it's at 130 on a different stock, not J&J, because I think it would be silly to do covered calls and sell J&J for 140. But let's say you have a different stock, it went down to 130. You have to basically sell 140 covered calls, and that is below your cost basis. But that's just something that you have to kind of deal with. And to be honest, there is ways around it though. And one way around it would be rolling. So let's just take an example. Let's do American Airlines, which I've been making money on very, very consistently in the Discord. I mean, I've done it over and over again. And I actually want to pick this stock because although I am up on this stock because I've been selling so much options, you can actually see that recently my average cost basis is $15.50. It is $15.50, so I'm below my average cost basis. But you can see that I have sold a 14.5 call option. So I have literally just picked my biggest wounded stock or my biggest issue in my portfolio, which is American Airlines. I just know on top of my head. That's because I sold a covered call at 14.5, but American Airlines is now 14.74. So I'm in that exact scenario that I just talked about, which is selling puts to get in. And then when a stock goes down significantly, right, I don't really have a choice to sell 15.50 at the time, right? So when I sold this 14.5 call option, let's just look at the exact day that I sold it. I sold it on March 27th, which was actually about a week ago. And we go to American Airlines. In the past 1 week, the stock is up 5.59%. So a pretty significant move for a fairly stable company. I mean, if you look at the 1-year chart, this is a very stable company. So, I sold a covered call and now I'm kind of dealing with the consequences because the stock is above the call option I sold. So what will I do? How will I manage this? Well, here's exactly how I'm going to manage it. So as soon as Monday opens up, which is tomorrow, and I go on my live trading call, what I'm going to do is I'm going to go to roll this position, okay? Because I don't want to sell American Airlines at 14.50. I want to keep the gravy train going, and I want to sell it maybe for 15 and a half. So what I'm going to do is I'm going to go to roll this position, and this is exactly how you want to manage a bigger portfolio. You want to do the wheel strategy for the majority of your money. And then if you ever get caught like this, like I just got caught right here, what you want to do is you still want to manage and adjust this position by rolling it up. So this position is expiring on 4/6. What I'm going to do is I'm going to go to April 21st, which is, not even 3 weeks away. And now I can sell the 15.5. Okay. I can sell the 15 for a profit, actually. If I sell the 15, I will collect $16 here. Okay, so I'm actually collecting $16 and moving from 14.5 to 15. And then guess what? When 421 comes around, if American Airlines is above 15, I can do this again. I can roll the 15 to 15.5. The next month, I can roll from 15.5 to 16. And the following month, I can roll from 16 to 16.5. I can continuously roll up infinity times. So when I'm running the wheel strategy, it is very important to understand rolling, which I do have a video on. You can look at that in the description. But for me, rolling is such a key. And rolling doesn't have to be hard. It's as simple as this. I see a $14.5 call option. Now I can roll to 15. And I'm going to go out, let's say, 2 weeks. Okay. Now in the future, if this hits 15, I can go out another 2 weeks or even 30 days. And I have done this over and over again to basically make a lot of money. I have made a lot of money by rolling continuously into infinity. You can see in my portfolio right here, most of my positions are actually for a gain. I do end up winning about 80 to 85% of my positions, but I will end up rolling, and I will even end up rolling spreads occasionally. But for me, I do like to hold spreads until expiration. And that's a big question I always get is, do you hold this until expiration, or should I take profit early? For me, I always say you can't go broke basically taking profit. It's okay to take profit, but if you want the absolute biggest raw return, I like basically not closing at all. The ways I manage my positions or actually a hands-off approach, I like to not manage my position and usually not close it. However, some positions I do have to close. So if I'm running the poor man's covered call strategy, I absolutely want to close it. Okay. But for bigger positions like the wheel strategy, I don't want to close the position. I just want to let it run. And towards the end of its expiration, I may end up rolling higher like I just showed you. And for me, it actually reduces standard deviation risk. It really reduces overall variance because when you're trading more, you actually get less results in most cases. Now, it's okay to trade more with a smaller portfolio, especially if you're doing strategies like the butterfly, you're doing strategies like spreads, you're doing straddles, which, by the way, I love straddles. I do straddles from time to time, especially on earnings. You know, for me, I use OptionSpy. I trust the software. My friend built it. I contributed to the algorithm. So I really like it. And what I learned, because we both worked at Goldman Sachs, was it is actually super profitable to buy call options for earnings events. I mean, Goldman Sachs has proved, I think the stats were, I don't remember if they were 98% or 108%, but they were really ridiculous high returns for buying options before earnings. And that's because, clearly stocks have, big returns for earnings. For example, like Apple, here we're getting a call credit spread, a debit put spread. I would come in with a debit put spread. Now, that is something that you have to spend money on, but it's okay because if you spend a little bit of money sometimes with your profits, right? If I'm picking maybe Amazon, etc., right? These, and actually you can see the implied move right here. So the implied move is not that big. It's only 1.89% on Apple. On Amazon, it's 3.38. But sometimes, tech stocks, and as you guys know, if you look at a stock that has earnings, sometimes the stock can report a good or bad event, and it could go up, 8%, 10%, 15%. I think recently Snap had a really big movement, and I was bearish on Snap for a long time. So in my community, I basically avoided this stock for as long as I could. I really haven't had it since it was like in the 40s. I did trade it briefly in the 40s. We made some money. I think it was like a weekly trade, and then I've not touched it. And as you can see, just complete breakdown. And that's not a bad thing if you're doing something like a put debit spread. So basically for me, I will buy call options. I'll actually sometimes buy put options. Like on Airbnb, I was very bearish on that stock for a long time. I ended up buying put debit spreads. I can in fact show you my history. For me, I like to be transparent, so I don't want to just talk at you. I want to show you my history on Airbnb. And I know that I ended up doing a put debit spread because I was very bearish on Airbnb. I just saw what happened with Facebook. I saw what happened with other tech stocks. And there it is, actually on my birthday on October 31st. I ended up buying a put debit spread for $1,200, and just 3 days later, I ended up closing the position for $2,250. So it's about $1,000 gain. And again, guys, if you're trading with six figures, like you don't want to do this with most of your portfolio. Like I always tell people when they join my Discord and they see my trades, is I can't promise this. I'm not going to do this every day. Like it's just impossible. Anyone that's going to promise you to make $1,000 a day out of 1,000 is just like they're completely lying to you. They're just like either scamming or lying, and it's ridiculous. You can have really good plays like this, and I do this on a quarterly basis. Every time I see earnings, I'll make some plays, but I mean, it's not possible to just buy options and have these type of returns on a weekly basis. It's not. I mean, you can't double your portfolio every week. If you could, I mean, I'd be doubling my 2 mil to 4 mil in a week, right? I'd have a yacht, a mansion, I don't know, right? It is impossible to have really huge returns. And actually, let me correct myself. I wouldn't say that it's completely impossible, but you would be doing it at a very high risk, and it would not be worth the return, because essentially you can take massive risk just like a casino. You can bet on a single number on a roulette table and get a 36x return, right? You can just bet on number 18 or number 22 and you can get a return that's 36 times. But again, your chances of winning is very slim. Your chances of winning actually are 1 in 38 because a roulette table has 38 slots and there's only 36 that can win. That's how the casino, by the way, makes money. Right? They make money by having a slight advantage, just like blackjack. The blackjack odds are 51 to 49. But if you can be the casino and you can sell options, you're going to have a really big advantage. Okay, so that's what I like to do. That's what I teach, is basically selling options, because then you can kind of be like the casino. You can collect small amounts of money consistently. And if you can collect $100 to $500 a day, and that really adds up. To me, that's not even small money. I mean, that's money that you can live on in a foreign country. I've traveled all over Europe, South America, and $100 a day goes really far. And I'm sure some of you guys, in America, you guys know that if you're from a foreign country, $1 to $500 a day can go really far. So for me, I'm always focused on diversifying my portfolio. And that's what this is about. Having proper asset allocation, because you don't want to just go all in on one stock like Tesla. And I had a man that I was working with who had a $50 million portfolio. He had $50 million and he had it all in Tesla at the peak. And I was telling him, you should really diversify. Now, despite the man being smart enough to gain that money through businesses and entrepreneurship, he was not smart enough to keep the money. Okay, there's two different things. You can make money and you can keep money. I'm very good at both. I'm good at making money in my portfolio consistently and keeping it. And some people, they just don't understand this concept. They're all about, how do I make a lot of money? And they don't think about keeping it. And that's where you find people that, I work with, folks that have 600,000. And then by the time they get to me, they say they watch my videos, and by the time they start coaching and seeing my trades, they end up losing half their portfolio, $300,000. It's best to be proactive. It's best to have proper asset allocation, proper risk management. For me, risk management is having at least 12 to 15 positions. If you have less than 15 positions, it's not that smart, okay? Especially if you have a lot of money. If you're working with 100 to $1 million and you have 3 positions, that is awful. That is a very big bet on a couple positions. You want to have multiple. So as you can see in my portfolio, I have American Airlines, I have Amazon, I have Google. I'm doing QQQ, put credit spreads here, which are doing pretty well on a small amount of capital. So as you can see here, I only put up 254 times. That's about $1,000, and I collected 50 in a week. So, that's a little bit over a 5% return. So again, you don't have to just make small money. You can definitely go a little bit bigger, but if you're going to do spreads and you have $100,000, you should not go more than 10% of your money in spreads. Like, you should have 10,000, no more, in spreads if you have $100,000. If you have $1 million, then you might want to go even lower. You might only want to have 5 or 6% of your money in $1 million. So that's 50 to 60 grand worth of spreads. And spreads are awesome. Again, you can make 10% a week on spreads. And I did grow my portfolio. I'll be fully transparent and honest. I grew a lot of my portfolio because I did spreads on Tesla.
When you're performing at your best, it's hard to imagine anything holding you back. But performance-inhibiting deposits restrict your engine's performance, robbing it of its true potential. Don't let anything stand between you and performing at your best. Shell V-Power Nitro Plus Premium Gasoline. Performance unbound.
Visit Vanguard.com/fixed income today.
Back when Tesla was growing like gangbusters in late 2020, 2021, I was doing put credit spreads and I was collecting 10, 15% a week. And at the time, even though this wasn't that long ago, I didn't really care because I knew that I'd be working for the rest of my life because I love working, I love coaching, and I knew that I'd be fine because I had a long time horizon. So I was willing to take higher risk, and that higher risk really paid off. It paid off big time because I was able to make 15% a week. Some months were 40%. In that year, I started with 100,000. In 2021, I ended the year with 700,000. But was that smart? I'm not sure. I'm not sure I would do that again because I did take excessive risk in 2021. I think, I do want to kind of step back because I did do a lot of research on Tesla. I was very confident that it would go up, but I didn't even follow my own rules of risk management. I kind of broke a lot of rules. So I want to just educate you and let you know that you should be wise on how you invest with asset allocation, with risk management, with managing your portfolio. So for example, even if you have 5% of your portfolio in spreads, you still don't want to have it all in one spread. So for me, QQQ is just $1,000 position. Adobe is a $500 times 8 is $4,000 position. Here, 5,000 times 15, $7,500 position. On Netflix, we have actually been very profitable. We've opened up positions that have expired, but our current positions are down. And that's okay because they're not huge positions. As you can see, my portfolio is beating Wall Street, is beating billionaires, is beating millionaires. It's literally beating almost everybody. Every YouTube guru included who just shows you their wins but not their losses, okay? People are too short-sighted, and I want to encourage you to kind of think more long-term. You want to have your money spread around, especially if you have 6 figures, because that's no joke. You don't have a choice. If that's money you worked for, you cannot lose it. You want to make sure that you grow that wealth. You want to make sure that you can rely on your portfolio in the future, just like me. I don't need to work. I work by choice. You want to be in a similar position where you are working on your hobbies and passions. You don't necessarily care as much about your active income. But at first, if you don't have a lot of money, you have to focus on active income. You have to work a job. You have to have a salary with benefits. You have to build up to the point where you can do this full time. And for me, this is a little bit crazy. I went full time at $100,000. That was very silly of me. It's silly. Okay, I should not have went full time at $100,000, but I took big risk and it paid off in life. Okay, so big risk can pay off huge, but for the most part, I would recommend that you take the consistent approach, even if it takes you a bit longer than me. I've been investing for 9 years. My first 3 years were not good. Okay, I didn't really know what I was doing. I had to go about it the hard way. It wasn't really until I had my internship at Goldman Sachs that I started to really understand that selling options is the way to go. Because before I was just kind of buying calls and praying. And now I have a system, I have a strategy, which is number one, the wheel. I am buying call options and I'm buying debit spreads for earnings. And I'm basically just, using options buy. I'm putting a small amount of money in, but I'm not going crazy. I'm not going crazy, okay? I don't do too much of it. I put in like 1 or 2% and that's it. I'm good. Okay, and I will, take advantage of call credit spreads for sure, because I think having both call credit spreads and put credit spreads in your portfolio is important. You want to have both. They both are useful because just in general, what I learned at Goldman Sachs was that just selling options in general works. Selling both puts and calls, and that's why you'll see in my portfolio, I am diversifying into selling puts on JD, which is a Chinese company, on Baba. I've made good money on Baba, really good money on Baba. And I'm doing it on tech stocks. I'm also doing it in consumer stocks like Oatly. I am basically in many different sectors, but I will be honest, I am very heavy on tech, and that is my choice. But I would say, in general, let's go back to SPY, where I'll wrap it up with how you should be investing 6 figures to 7 figures. You should be investing in different sectors. Now, I will also be clear with you. I have a large amount of money in SPY, $1.2 million in SPY. So SPY for me is like a big support in my portfolio. This ETF is diversified. It has 500 companies within it. So I don't need to spend all my time trading because I don't think trading should take over your life. I only trade 3 hours a week. That's it. I do it Monday, Wednesday, and Friday, and I do it live on my calls. I don't want to trade all day. I think it's totally unhealthy to be by your computer just staring at the screen, watching things move up and down. Nonetheless, it being stressful to watch your money, and it also doesn't make you more money to stare at your money all day. So for me, I love safety, consistency, and stable companies and ETFs like SPY. So if I can run, this is actually a covered strangle. Okay, this is something that I've taught a lot in my community, is a covered strangle. It's basically this. Okay, so say you have shares of a stock. Okay, so I have SPY shares. I have 3,000 shares, which is a whole lot of shares, right? But I don't know. Some clients have way more shares than I do. But anyways, so what I do is I hold these shares and then I am selling covered calls. So as you can see, I'm selling the 402 covered call, which is actually in the money, meaning that I'm going to have to roll it up this Monday. It's actually not good. This is another detractor at the moment. But in general, I have done phenomenally on SPY because this whole past 3 months, SPY is, 6%. I've been selling options making, 3 to 4% a month for the past 3 months. So I'm way higher than this S&P 500 return. But as you can see, overall on the stock itself, I am down, and I'm going to have to roll this covered call. But back to what the covered strangle is, it's basically doing covered calls and then also selling puts on the same stock. So I'm still selling puts on SPY. I am doing this on margin, and margin is a whole can of worms. I won't recommend it to most people. I always tell people, even when they join my community, it's, hey, you still have to do 6 months of consistent profits before you start using margin. But once you know what you're doing, you can use margin safely. And you can see that all the time in real estate. I mean, people are buying houses for $1 million. They're putting $200,000 down, taking an $800,000 loan, and nobody seems to complain about real estate. But once I say that on my $2 million, I am leveraging and borrowing $500,000, which is 25%, people lose their mind. Oh, you're doing something risky and crazy. Well, actually, based on my facts and results, I'm not. I am borrowing money using margin, and my portfolio is still moving less than S&P 500. I am literally using margin and having less volatility than everyone else who's not using margin. Margin is a whole topic that I want to cover, especially when I'm working with you hands-on, because people can really get in trouble with margin. So I don't want to go into full detail on YouTube about it. I think margin is one of the riskiest things that you can do, but if you know what you're doing, it's also literally the safest thing that you can also do. I read this research report by Yale economists. I can no longer find it, but Yale economists, PhDs, researchers who are very risk averse, they literally said that most investors should be invested 110% in the market. And if they're not, they are missing out on long-term gains. And that's what I've been following for a very long time. I've been using leverage, and I've been using safe strategies like covered calls, selling puts, the wheel, safely using spreads, sticking to selling strategies, sometimes buying calls and debit spreads only on earnings. And I've been using this to have consistent results. If you want to have more consistent results, fix losing positions, I really think you should check out my video on rolling right here.
Are you trading S&P or NASDAQ ETFs? Discover futures from CME Group on the equity indices you know and love. With around-the-clock liquidity and lower margin requirements, enjoy the benefits unique to futures. Start trading today.
Metro presents a tale of two wireless customers.
I've been a loyal customer since today.
Forever.
Which means I get all the deals.
Absolutely no deals.
It's like they totally see me.
Forgot I exist.
That's such yada yada.
I hate yada yada.
But now, with Metro, existing customers can get the same great deals as new customers.
Finally, introducing Metro Flex. Get that new customer feeling again and again. Free 5G phones when you join, and the same great deals as new customers when you stay. That's not a yada yada. I found only at Metro.
Hey guys, what's going on? In this video, I want to talk about margin and give you every single thing that I know about margin in this one video. And I specifically want to talk about the appropriate use of margin, what the research says about margin, and how I'm using margin in my two different portfolios. As you can see on the screen right now, I want to talk about using 110% margin. Now, this is specifically a research report that I remember reading from Yale, but I can't find it online. I found something very similar, though, supporting what actual professionals, PhDs, and financiers say about margin use. Now, there is a lot of kind of hypocrisy. There's a lot of debate about how to actually use margin properly. So I'm going to give you my personal opinion and what I've actually been doing, because for me, it's been working. And for many of my clients, we also use margin. As soon as they're able to trade consistently and profitably, using margin is a no-brainer. Okay, so right now, I have researched, or I put in 110% margin Yale reports, okay? This is one of the first articles that comes up. It's by some PhDs, right? It's a .org research paper. And the abstract here is by employing leverage to gain more exposure to stocks when young, okay? This is a relative term, okay? Because even if you're 50 years old, but you're looking to retire at 70, that is young because you have a 20-year horizon. So for me, what young means is you still have at least 10 to 20 more years of investing, which pretty much everyone watching does. Even if you're in your older age and you're already retired, you still probably have a decent amount of time to deploy margin strategies, at least 10%. And later on in this video, I'm actually going to talk about how I use 200 to 300%. Again, it sounds crazy, but you really need to listen to how I'm doing it, because I'm not going about it blindly. I'm not using it in a risky way. In fact, I've actually never had a margin call. So that's one of the risks with margin trading, is if it goes against you, you have a margin call and you end up losing and, being forced to sell your assets. I need you to understand, part of my job, if you will, as a coach is to actually preserve wealth. Now, I don't have any high net worth clients. I don't have too many millionaires. Actually, most of my students are starting with $10,000 to $25,000. But still, wealth preservation and understanding how to properly trade without losing money is one of the most important things that I focus on, because it doesn't really matter where you start. Even if you start with a few $1,000s, my goal, and what I think your goal and the point of you even watching this, is you're going to be trading long term and you're going to get to 5, 6, and 7 and potentially 8 figures in your portfolio over time. And you need to first understand how to manage small amounts of money to then be able to manage medium and large amounts of money. I started very small I'm very happy because I made all these mistakes in the beginning. They're pretty much unavoidable. Even though I had mentors, I still made mistakes. So it's really important to think about wealth preservation. When I was at Goldman Sachs, all these, 100...
Ghirardelli Intense Dark makes life a bite better.
Big Labor Day deals are happening now at Best Buy. Shop now and save.
Millionaires, these people have invented things. They're CEOs. They've made big changes in the world. They're actually getting a roughly 3 to 4% return per year, which is super low. You might ask yourself, why are these people Goldman Sachs clients? Well, that's because for them, they're really looking to preserve their wealth and just match inflation because they're so rich already. They're not really looking for growth. Now, I understand that's none of the people watching my videos right now. All of you guys, I already know because I've coached 3,000 people. You have, a few $1,000s, maybe you have 5 figures, and some people have 6 figures. That's completely okay. That's actually who I focus on because that's just the majority of people looking for help. For me, here's what the research says, okay? If you're young or you have a horizon of 10 to 20 years, individuals can achieve better diversification across time using stock data going back to 1871, okay? This research report is, dating back a long time. We show that buying stock on margin when young combined with more conservative investments when older stochastically dominates standard investment strategies. This is literally a research report done by professionals saying that margin makes a lot of sense. And this data is going back a very long time. Ever since I read this, I was probably working at Goldman Sachs at the time. This was probably 2016, so this was 7 years ago. I've started to utilize margin, and it has been an absolute game changer. And again, in 7 years, I went through, COVID. I went through, quite a bit of crashes, and I've had a lot of tests on my portfolio. I haven't even followed the best risk management practices. However, I've never had a margin call. That's very important because a margin call is devastating. But, if you really understand by the end of this video, you shouldn't really have a margin call because something that you can do, say you sell some puts, say you sell puts that are a 10 delta, super out of the money, and you use, let's say, $10,000 of margin, or, if you're using SPY, let's say you use $40,000 of margin, even if that's a lot of money for you, okay? If it goes down, what you can do is you can roll lower, okay? Say you have a 100 strike, okay? You can roll down to 95. 93, 91, and you can do that week after week after week, rolling down. And that's basically my strategy to never experience an assignment that is devastating, okay? And I've done this, again, for 7 years. I can't even think of a situation where I would have a margin call or where I would have a devastating outcome. I mean, the chances are truly less than 1% if you're doing this correctly, okay? So to continue this article, and by the way, we have a Goldman Sachs article that I want to look at as well, because specifically we've been, thinking that at some point in 2023, we would get a pullback. Even Goldman Sachs has been really confused about this. But anyways, both traditional life cycle investments and 100% stock investments, the expected retirement wealth is 90% higher compared to life cycle funds and 19% higher compared to 100% stock investments. The expected gain would allow workers to retire almost 6 years earlier or extend their standard of living during retirement by 27 years. Okay, this is the most insane thing. We have all these stock videos on YouTube. We have all these get rich quick and these gurus talking. But let's actually talk about the research, actual PhDs, people that are studying this stuff. Now, I get it. It's boring to read this stuff. I do read this stuff in my free time. This is real research. This is what I would be paying attention to. Like, truly, if someone is saying, okay, the research says that you can retire 6 years earlier, this is a fact versus, you can retire tomorrow with some brand new golden strategy. I've never really seen that. It's like winning the lottery. But this right here, shedding 6 years or getting closer to retirement by 6 years, that's a hell of a difference. Imagine instead of being 50 and you're retiring at 44. Or instead of 60, it's, 54, right? It's a huge, huge difference. So when I was reading this research report, they were talking about a 20-year-old might be 90-10 in stocks versus bonds, okay? This is a little bit interesting because if you look at research reports, if you look at what financial advisors talk about, they always suggest bonds, okay? Now, I know some people that get into their later years that have bigger portfolios. Even Vanguard, Jack Bogle, before he passed away, he was talking about, taking your age, taking 100 minus your age. So let's say you're 50. Take 100 minus your age, which is 50. That's 50. So you do 50-50 stocks and bonds. Me personally, there was a research report that I read about turning stocks into bonds. Okay, I studied this very, very well. In fact, that's why I use covered calls. You might not understand this fully, but when you're doing a covered call that's in the money or at the money and you're collecting a lot of premium, it's specifically in the money. I'll show you an example, actually. Let me just quickly show you an example of why I think bonds are completely useless, in that when you use margin, you should just go 100% options. Again, it sounds risky, but it's really not, okay? So actually, I have VTV in my portfolio. In my Discord community, I said that I do expect a little bit of a pullback in the market any day. And when I specifically looked at growth versus value, okay, so growth companies, obviously, we know those are the Amazons, the Microsofts of the world. They are fairly risky right now because they're at a 52-week high. Now, don't get me wrong, value stocks are also at a 52-week high, but if you look at the volatility, it's very low. And the next crash that we get, or the next pullback we get, which I'm expecting anytime now, I don't know, in September, in October, or later in 2023, when that happens, right, if you're watching this in the future, it's still relevant for the future. When that happens, value stocks are going to outperform growth stocks. That's because value stocks have more support to them. They're not valued as highly. Their price to sales ratio is not as high. Their price to earnings ratio is not high. If we actually look at the holdings here, the holdings in VTV are Berkshire, United Health, ExxonMobil, Johnson & Johnson, JP Morgan, Procter & Gamble, Chevron. Okay, these companies have a lot of stability to them because they're huge mega cap companies. And what value means is it's a relative metric. Okay, growth means that, Amazon, you take a look at the price to earnings ratio, last time I checked, it was like 68. But if you take a look at, one of these companies like Chevron, specifically, if I take a look at Chevron right now, you'll see that, they have a dividend and the price earnings ratio is 10. Just so you know, the S&P 500 average is like 18. So this right here, the price earnings ratio is below the average of the S&P 500, which is already safe. And that's why I decided to go into VTV. But specifically talking about bonds, in VTV, what I did was I did a covered call. Okay, so as you can see, I just recently did this. I opened up this position on August 9th. It's August 15th now. Again, it doesn't really matter. What matters is the logic and the thought process that I'm using. You can watch this in 5 years and you still, which was only 9 days out, collecting $1,200. I mean, that's $1,200 in 9 days. Now, for most people, if you can make $1,200 like basically a week, you're already really on the right track to pretty much retiring. I mean, it's not the most money in the world, but hey, if you can make $4,800 a month, you can certainly do a lot with that money, okay? All right, so what I did was I bought several hundred shares. I bought 1,200 shares. Yeah, I dumped a whole bunch of money in. I dumped $174,000, and that's because I expect the market to pull back. And what I'm trying to do with this position is make it similar to a fixed income instrument. Okay, a fixed income instrument is basically like a bond. A bond is something that has no risk, right? Like a treasury bill, 30-year note. These assets just pay you, kind of like a CD. Okay, you go to the bank, you just drop your money, you get paid a guaranteed income from the government. Okay, here I'm trying to do something very similar, but with stocks. Okay, I'm trying to get a little bit higher return, but have it still mirror something extremely safe, right? So value stocks are extremely safe. I bought 1,200 shares and then I sold a 146 covered call. Okay, so I did 12 contracts here, and as you can see, the market went down by $270, but my options here made $624. And this is truly why I think bonds are useless. Okay, you should have, again, going back to the formula, 100 minus your age. I'm going to tell you this is the basic formula. I'm going to tell you my opinion after. The basic formula is 100 minus your age and the rest are bonds. But I replace bonds with super safe covered calls, okay? Probably never even heard this on YouTube because this is something that most people don't understand, even if they're finance influencers, because they're influencers, they don't have a financial education or actual work experience in the financial advisory world, okay? I wasn't a financial advisor, I was actually a financial analyst, and I spent time at Goldman Sachs. Again, I didn't have a full-time job there. I already had all the financial education that I needed. I had tons of internships. I had tons of jobs, tons of mentors. I didn't want a finance job. That's why I actually took a consulting job to learn more about technology because I was a software analyst. So after that, I did not want to work in finance anymore. It is not a fun job. Plus, when you work in finance, you're not able to trade. And that was one of the biggest issues for me, that one of the biggest reasons I didn't take a job was because I wanted to trade and not be restricted, and many companies restrict you. So again, 100 minus your age, and that's what you should have in the safest covered calls. Now, I still love covered calls in general. You can actually have, if you have $100,000, you can put all $100,000 into covered calls. That's not a problem. But what I'm saying is, if you want to have bonds, if you want to be safer, okay, what you can do is do covered calls on the safest stocks possible in the money, okay? Now, there's some nuances there. I went a little bit out of the money. I had my average cost here 145.56, and then I sold a 146 covered call. So I picked the soonest out of the money option. Now, I did that because this is a really low risk. But had this been a little bit higher risk fund or a higher risk ETF or a higher risk stock, then I would have went a little bit more in the money. So that is what the research says. 100 minus your age. Jack Bogle talked about this. Vanguard, trillions of dollars asset manager. They have research on this. Me personally, I have 100% of my net worth. I walk the talk. I mean, heck, I could open my bank account. There's some security issues there. I literally have nothing in my bank accounts. I literally have no money. Okay, I'm cash poor. I put everything into options. Okay, I have 2 portfolios and everything is there. That's 100% of my worth because I really trust the process. I mean, I've been doing it for a decade, and my process is basically, instead of 100 minus your age, I actually go on margin, okay? So tracking back to the margin topic, I'm using margin because I can't find any research currently, but I read tons of research before, and I read lots of internal research, okay? When I was working inside Wall Street, I was reading internal research from hedge funds, which are not shared to the public, okay? And what I learned was, again, they say 110%. I actually take it to the next level. I actually invest a lot more than 10% in margin. I'm going 40% on margin. In fact, if we look at my portfolio right now, and Robinhood doesn't actually accurately track this, but if I go to investing, it says I'm fully invested in stocks and options. But if we actually take my notional value is basically like how much I have in exposure with options in total, right? So for example, I have a 235 put option on Tesla. I finally jumped into Tesla after it's gone down a bit. Looking at the 235 put, I sold 15 contracts, which is, that's roughly, right, you would take 10 times 235, that's 235,000, plus another like 112 and a half, so that's going to be 300 and basically $352,500 in notional value, okay? So I have that $350K that I sold, okay? So this is money that I don't really have. This is money that I'm using on margin. And in Tesla's example, it's a little bit riskier because it's really close to the money, but a majority of what I'm selling puts on is going to be those safer SPY and QQQ ETFs. I'm just trying to look in my portfolio where they are because they may have recently expired because I have been doing some zero DTE trading. I know I'm probably teaching you so much in this video. Basically, zero DTE trading means 0 days to expiration. I've been doing that because I feel like the market is a little bit in a vulnerable, risky place. And because of that, I've been doing a little bit of shorter term trading, which is not really typical of me. Now, last thing I really want to cover is where the market's at and why I'm doing a little bit shorter term trading. And lastly, I'll just tie in how I would basically use margin, which I already said in the beginning. It's by selling puts mainly. QQQ, SPY, if you have a smaller portfolio, you can still sell put options on just high quality companies, right? It could be the American Airlines that I've been recommending on this channel for 2 years now. I mean, I've been talking about American Airlines. Everyone's talking about the Rivian and the SoFi And the Palantir, I love Palantir too, and I've recommended at $7. But truly speaking, there's a lot of hype out there. There's a lot of interest out there. I know you guys are super excited for some of these stocks to 10, 50x. But truly speaking, American Airlines has been a bread and butter stock for me. It's been absolute money. It's been just printing cash because, if I take a look at the chart, let me just show you what American Airlines looks like and why I'm comfortable using margin on a stock like this. If I'm going to use margin, I'm going to pick a stock that's stable. I'm going to pick a stock that has tremendous support, and I want to also sell options that are very low delta. So, I talked about not getting a margin call, and the way you do that is by you go for a 10 delta, you go for a 12 delta. You pick an ETF that has, tremendously high quality companies inside there, right? The big mega cap companies like SPY, those are all components, right? The 500 largest companies in the world. And even if the market crashes, you roll down. So I'll show you an example of that in just a moment. But American Airlines, right? 1585. This stock over the past 5 years, I wasn't trading it in 2018, but as soon as it fell to, these levels in 2020, which is basically when I was, starting this YouTube channel, from the very beginning, I said, I love American Airlines. This is one of the best companies I've seen because it's American Airlines. Like, it's America, right? It's a pretty good bet to bet on America financially, okay, financially speaking. And then the airlines are an essential part of the economy. So, this was COVID, and COVID crushed airlines because people can't travel, but, people are traveling more, and they really can't go bankrupt because they're going to get saved by the U.S. government. And yeah, American Airlines, the only downside is they have tons of debt. The debt is very high, okay, but that's besides the point. I think this company is going to get bailed out in worst case scenario. And then airlines also historically have always had a lot of debt. It's not easy running an airline business because the airplanes are super expensive and there's lots of other costs associated with being an airline business. The pilots are pretty expensive, and there's also maintenance and repair, and there's also tons of insurance, and there's also tons of debts and loan interest payments that they have to make. But taking a look at American Airlines, just one of the most stable stocks. Truly speaking, you guys are chasing those SoFis, you guys that are watching those Palantir videos. I try to keep this channel away from recommending specific stocks because I've done that in the past. I've been right. But as soon as the stock pulls back, I get a bunch of comments saying how I was wrong. But look, on a long-term basis, I've been one of the most successful investors, even though I'm investing in sometimes companies that are fairly expensive. I've caught NIO at $4, and I've kept recommending it since $4, okay? And I've recommended it, yes, at higher points than it is now. And people that started watching me are upset because they missed the $4 that I've recommended. But from the very beginning, if from my results over a long period of time, it's been incredible. It's been incredible. But from any short period of time, sure, I've had my mistakes. I'm only human. I don't always know the exact right price to buy everything. I just don't, and nobody does. And if they say they do, it's a lie. I don't know. And I worked in this industry for a long time, and the people that are the best traders, they don't know. And their bosses, they also don't know. This is a completely random game. However, there are nuances and there's strategies that just work, and that's the research of it, okay? So I always try to understand this game, but there's truly, you can't really fully understand it because there's a random walk hypothesis, which basically means that the stock market is pretty random, okay? But looking at American Airlines, this is anything but random. This is one of the most predictable companies. I just can't speak enough good things. I've been just destroying it with this company, and I have a $10 return right now, but I do this every single week or every 2 weeks, right? Because I've been getting a little bit lazier lately. I don't want to trade weekly because if I can make the same money in 2 weeks, then why not? And I've been telling my students, hey, relax, we're making money. We don't need to over trade here, okay? Because way too many people, they join the Discord community, which, again, as always, first link in the description. You can watch a free training, book a call, and learn about the pricing and pick a package that works for you. And that way you don't get scammed because there's too many scam comments in my description. In everyone's description, I can't control that, okay? So please be careful of scammers. I'm not going to personally reach out to you. It's only the first link by getting on a live call is how I actually sell my Discord. That's it, nothing else. And basically, a lot of people, they come in and they have this notion of being an active trader, but that's really not what I'm teaching on the channel. I'm really teaching the passive income component. And believe it or not, but outside of making these videos, which, it's only like maybe 30 minutes every couple of days, I'm trying to upload maybe 3 or 4 times a week. Aside from coaching, my group coaching, I'm really not trading outside of that. Everything I do is on camera. Everything I buy and sell is posted. I really don't want to make this a full-time job because it shouldn't be. Investing should be investing, making your money work for you, not working and chasing your money and like paying really close attention to it, because that kind of defeats the purpose of investing. Just go get another job, right? American Airlines is the exact example of I just sell options 1 to 2 weeks out. I pick a pretty low delta. So actually, there's a difference. Sometimes I look at delta, but with American Airlines, I'm looking at the support. There's tremendous support at 1550. In fact, if I go over my history, and this is how well I know American Airlines. It went up to 1835 recently, okay? And I really started to not like it. I mean, I love the company, but I don't like it at 1835. So if we look at my history, I sold puts 15, 16, 15 and a half, 15 and a half, 15 and a half, 15, 13 and a half, 13.5. You don't see me chasing it to 18. You don't see me chasing it to 17. Unfortunately, I had to back off of American Airlines for a whole month. I mean, look, I sold June 26th, and I didn't touch it again until July 24th. I had to avoid the stock for, 28 days. And that's because I think that it was getting very expensive. So look, if I continue to look at my history of American Airlines, I mean, it's just 13, 14 and a half, 13, 14 and a half, 13. I'm just running the wheel strategy, which is like my very favorite strategy that I can do in American Airlines. And as you can see, I continue to go back into 2022. I'm still selling 13 puts, 13 and a half, 12 and a half covered calls. I'm just running the wheel strategy around the 13 level, 14 level, 13. I mean, look, I'm literally going back and showing you guys my history. I mean, just transparently, I don't want to just talk to talk. I'm, just take a look at my screen. We have July 18, July 11. You can still see that it's just the same strikes, and it's just collection of premium, $300, $55. I had shares here and actually sold the shares at $15.25. I literally sold the shares here at $15.25. So you can see how I've been selling puts, covered calls, and then finally getting into a 15.27, selling the shares. I mean, I've been perfect on this. I'm not trying to brag here. Again, I'm not perfect. I don't have a 3x return in a year. Some people claim they have that. I don't believe them. Okay, but I'm having a good return. It's not enormous, but it's a really good, consistent return. Again, that's all I really care about is consistency. You can see here how looks like I had a sell call at 19 and a half, 20, 17. So American Airlines was hovering a little bit higher in 2021. You can see how I'm still going back now. 2020, guys, 2020. I'm going back 3 years, showing you. Again, I'm not just telling you, showing you. 2020, maybe I'll even go, I don't know, how far back does this go? You can still see I'm still running the wheel. 3 years of running the wheel. Still scrolling here, 2020, July of 2020, June of 2020. I'm gonna scroll to the very bottom. Trading it since 2018, okay, in this portfolio, right? I've had, I've been moving portfolios, but in Robinhood since 2018, I've been trading the same stock. Okay. Now, talking a little bit more about how to use margin. Specifically, you always want to use margin, but you want to be very careful when the outlook is kind of grim. Okay. So this is a research report about 2023. And now that we're more than half done 2023, I want to see if Goldman Sachs was spot on or not, because they released this research report in late 2022. And this is some of the smartest, best economic analyst in the world, okay? And this is what he had to say about the market going into 2023, which, by the way, I have a lot of agreement here, and I still agree. So unfortunately, he's been very wrong so far, and I haven't brought up the fact that I think we're going to fall in January, but now I'm bringing up the fact that in the second half, or really in the fourth quarter of 2023, I'm expecting a pullback, okay? So the longer we are in a bull cycle, in a bull market, the more predictable or the more certain an eventual pullback is going to happen. because the market has cycles. Okay, so the article says the key macroeconomic question of the year has been whether inflationary overheating can be reversed without a recession. I don't think so. I think in most cases we're going to have some sort of recession, even if it's a short-term one, okay? And we've already seen that. We've already seen housing prices come down a significant amount. Inventory out there is pretty low. People don't want to sell their house. They're not getting the price that they want. We also see BlackRock buying up lots of property, which is truly scary. I don't know if you guys know this, but you have companies like BlackRock, which basically rule the world, and they have trillions of dollars of assets. They're buying up all the inventory, and they're turning this into a renter's market. So, people cannot afford to buy. There's not enough inventory out there, so everyone is pretty much being forced into renting, and that's a way of controlling their.
If you can dream it, then bread provides. Yeah, because bread is everyone, and it's the type of journey that should be fun. The life you always wanted, time to make it true, because you deserve it. And Bread is the one for you. Bread Financial, the best thing since online banking. Churches, Newts, and the Raps. Yeah, choose any two starting at $4. Churches.
They're American people, right? I don't want to say that buying a house is great, but at least having the option to buy a house is great, all right? If you don't even have the option to own property, that's bad. Now, my personal belief is I don't want to own any property, and I don't own anything, and I don't have any plans to, because I think that option trading consistently and safely is better than real estate, and it's less management. I don't want to have anyone calling me and texting me just because I love my freedom. I love being having that freedom, okay? So again, this best analyst in the world was saying that the first step in keeping the adjustment process on track is ensuring that GDP growth remains below potential. The fiscal tightening that helps it slow the economy this year has mostly run its course, but the large tightening in financial conditions engineered by the Fed should keep GDP growth near 1% in 2023. So yeah, the United States is growing, but very, very little, and this is a very fragile number because 1% is very close to 0%. So again, we can get a shift, and the whole point of this, are we going to have a soft landing or a hard landing? Okay, I'm expecting a soft one, okay, because there's a lot of wealthy people in the market. Sure, it seems to be some manipulation going on. There does seem to be by the Federal Reserve. There seems to be, you know what I mean? The wealthier people are doing quite well in the stock market. They tend to have more information, from my belief. We've seen that with some political candidates, being able to predict the stock market. And they're not stock market geniuses. They just have, information not accessible to the public. For many reasons, though, a lot of people are invested in the stock market. So I don't think it's going to have a hard landing. I think we're going to have a softer landing. So, going into more of this research, I'm going to kind of glance over this, but basically the research article talks about, wage growth and real GDP, which are both really important economic indicators. This is what economists look at. This is what economists are trying to predict here. Because, the labor market and the wage market has a lot to do with the stock market. But the way this ties into margin trading is, and I tried to Google as much as I could, everyone should be using margin. I truly can't find the research that I used to read, and, it's been a long time now, 7 years, so I believe I was reading research that was internal to the hedge fund that I was working for. But, for me, I mentioned that I use up to 200% of my portfolio margin. Now, that's a different portfolio that I usually don't cover on this YouTube channel. I've mentioned it in the last video. But for me, if I were to give advice, obviously I'm not a financial advisor. I have tons of experience. I'm wealthy, and I've been doing this basically as my full-time job, if you will. My basic advice would be to use margin once you are comfortable in getting consistent returns. Start with 10% and continue to increase as you feel necessary. For me, I feel it necessary to use 200%. What I'm doing, though, is I'm selling very low delta options on some of the highest quality companies. So if you have any questions, feel free to drop a comment. I will try to respond with a follow-up video on this into the future. Leave a like on the video, subscribe, have notification bell on because I try to make the highest quality videos. I'm not here to upload lots of quantity. I'm here to upload lots of quality to teach you how to be the best option trader, the most stable investor in the world, ideally, so you can retire and live a life of freedom. So thanks so much, and I'll see you guys in the next video.
Here we are driving down the road. All of a sudden, look at that. You know what we can do now? Go to SafeLife.com. They are the experts at replacing and recalibrating windshields. If you get a crack in your windshield, there's only one choice. Save Life Replace.
With MetroFlex, I get a free 5G phone when I join.
And I can get the same great deals as new customers when I stay.
So if this poor man's covered call position hits its maximum profit, you will make $1,441 on essentially $5,000 investment. All right, we need to discuss everything you need to know about the poor man's covered call strategy and then go over an example so you can print money with a small portfolio. Poor man's covered calls will help you grow your portfolio quickly using safe stocks, and this is an unbeatable small option trading strategy that I've been utilizing for the past 9 years. I specifically really love the poor man's covered call because you don't have to put up a lot of collateral or a lot of capital to make a lot of money. So for me, I'm not running this strategy as much anymore because my portfolio is scaled at this point. But on my journey to scaling to 7 figures, I did utilize this strategy a lot. Now, there's a lot of pros and cons, and I'm going to teach you how to properly do a poor man's covered call in this video. And the example I'm going to go over, despite being a few months old, this video will be your full guide on the poor man's covered call strategy, including how to manage your risk, close, roll, and pick the stock for the strategy properly. So first of all, what is a poor man's covered call? The poor man's covered call, or the PMCC, is a bullish option strategy that is similar to a covered call without needing 100 shares. So when I share the example, it's really going to wow you because you don't have to have $10,000 or $15,000 because with a poor man's covered call, you can essentially just put up a very small fraction of the capital and still get a very big reward. And this is a perfect strategy for trading a small portfolio. A poor man's covered call is an alternative to the covered call strategy in many ways. It has a similar return and risk profile as a covered call. For me, to be honest, any of the covered calls that I have right now, take BABA for example, this could be easily turned into a poor man's covered call. The PMCC strategy allows for, in many cases, 10% of what buying 100 shares would cost in collateral. The PMCC reduces the capital margin requirement of a traditional covered call by replacing a long stock with an in-the-money call option. So this call option basically just replaces the shares, so you no longer have to have 100 shares. The in-the-money call option is referred to as a LEAP if it's longer than a year to expiration. And in most cases, you do want to buy a long leap option because it's going to be very similar to owning stock for a fraction of the price. Leap options are typically available for a variety of underlying assets, such as stocks, indexes, and ETFs. I would honestly do a poor man's covered call on SPY or Triple Q. These are indexes with which you can gain a lot of leverage on by doing the poor man's covered call. Like other option contracts, a leap gives the holder the right, but not the obligation, to buy or sell the underlying asset at a predetermined price. Very similar to a call option. It is exactly the same, in fact. It's basically a call option that's way out in the future. Leap options can be attractive to investors who are looking to gain exposure to an underlying asset. So for me, you can see that I do have a covered call on Alibaba right now, and I'm going to be giving you an example on Palantir. But right now, Alibaba, I have a whole lot of money in it, and I'm actually up a lot. I'm up $20,000 on Alibaba. Now, for me, it's not a problem buying 100 shares or 1,000 shares, as you can see, because I have the capital. But if I didn't have the capital, then I would still be running the poor man's covered call strategy. Make sure to watch the rest of this video because I'm going to be covering the benefits, and there are obviously cons to the poor man's covered call and the reason why I'm not really running it at the moment. But anyways, I want to discuss why this strategy is so flexible and so amazing for small accounts and how to set up a poor man's covered call, the basics around it. So step number 1, what you want to do is you want to buy a deep in the money call option in a long-term expiration cycle. So let's just pick Apple, for example, because Apple is a great company to own, but it's not necessarily cheap. If you wanted to buy 100 shares of Apple, it would be $16,454 at the time I'm making this video. And instead, what you can do is if I go to trade Apple options, instead I can go out into the future. So Let's just go out into 2024. Let's go to January 19, 2024. So if I go to buy call option and then I just buy a call option that's in the money, and I'll give you the best strikes in an example very soon, but let's just go to 140 for now. If I end up buying this, instead of having to basically pay the $16,000, I only have to pay $3,500. Now that is a big help because it's basically a 1/5 cost. So instead of paying 15K, you're paying 3K, which is 1/5, 20%. That's amazing. That's how you actually start off with the poor man's covered call. Now, step number 2, what you want to do is you want to sell an out of the money call option using your leap. So this is pretty simple. So as soon as you buy a call option, and in fact, you can set this trade up in one trade. You don't have to trade it separately. You can do it in one trade. So let's say I have a 140 call. Now what I can do is I can use this call option, which is only $3,500, to sell covered calls against it. So let's go out about 33 days, about a month out, okay? And if I go a month out, you can see that I can go to sell call option. Let's just say I want to sell the 167.5. Let's just pick this as an example. You can see now that I am actually collecting $435, and the collateral that I am using is 35. So I'm actually collecting over a 10% return in about a month on this poor man's covered call position. The only thing that you really need to know, in addition to opening up a poor man's covered call, is how to actually manage this trade and how to avoid assignment. How do you roll and get out of a potentially risky position if this poor man's covered call goes into the money? So let's look at another example. So now we're going to take a look at Palantir's options. We want to purchase a leap call that will see price changes similar to the stock. So look for a call option with a delta of about 0.8 or more. As a starting point when searching for an appropriate delta, check options that are at least 20% in the money. I'll show you exactly what that means. But for a particular volatile stock, you may need to go even deeper in the money to find the delta that you're looking for. I'll show you why that is so important using Palantir right now, and I'll show you an example of weekly covered calls. So first of all, buying a call option, the most important thing for a leap is you want to go out about 1 year. So today is June 17. I'm going to go out until March 17, which would not quite be a leap by definition, or January 19, which would be about a year in 1/2. So I'm going to go for a year and a half. Unfortunately, Palantir does not have exactly 1 year. So January 19, 2024 will be the play that I'm going to look at. Now, Palantir stock is at $7.80. Check out Palantir's technicals. Palantir was trading well above $20 for a significant period of time. And then obviously the stock market has fallen down, with tech stocks taking a really big beating, especially the high volatile tech stocks, because as interest rates rise, these tech stocks are less attractive. Now Palantir has sold off to levels where I think it's just absolutely cheap on a long-term basis. Under $8 per share is about 1/3 of the price that it used to trade within. Now, it's not likely that the stock is going to pull back up to $25 in a short swing, right? That's just not likely to happen. But if Palantir reports some good earnings, this stock can be a $14 or $15 stock again. So I expect that to take some time. However, this leap call option going for January 19, 2024 gives us plenty of time for that to play out. So what I'm going to look for right now is a $10 strike, and I'm going to see what the delta is. Now, obviously, this is an out of the money option, and the delta is 0.56, far from the 0.8 that I'm looking for. Now, if I click the $5 option, the delta here is 0.82, which is perfect. I'm looking for about a 0.8 delta. This is a 0.82 delta, meaning there's an 82% chance for this option to expire in the money. And fun fact, in poker, if you have 2 aces, the chances of you winning is also 82% if you're playing one-on-one. So this is basically a very high probability play, very awesome. And the break even on this leap call option is $9.08. Not too bad considering Palantir can go up to $14 by expiration. If it were to go up to $14, then the total profit would be about $9, and you're paying $4. So you'll be able to a little bit more than double your money, or turn $400 into $900 or $4,000 into $9,000. Now, let me show you how to make this a lot better on yourself. So if you do pay $400, that's fine. However, I'm going to show you how you can also make weekly income on this position. Okay, so total cost is $408, and your max profit is unlimited. And you can see right here that your break even is right here around $9.10. So a few things can happen. If Palantir ends up above $9.08 right here, our break-even point, by January 2024 or on this expiration date, then you have made money. But another thing that can happen is let's say that Palantir goes up by $1 in 1 month. So what you will actually have is a profit, and you can actually sell this call option or this leap option and just get rid of it for a profit. And the exact amount of money that you're going to make is actually that $1 move times this 0.82 delta. So this option will go up by the amount of the dollar times the delta, which is 82 cents. Now, 82 cents is actually about a 20% return, because 10% of 4 is 40 cents. 20% is about 80 cents. And if this stock were to go up by $1, this option will go up 80 cents, which is actually a 20% return. So you can have a 20% return in 1 month or 2 months, right? You can have a very short-term swing of 10, 20%, or even more than that if Palantir recovers quickly. That is a very smart strategy, and I do like taking profit early. Whenever I see profits, if it's a 10, 20% return in a month, then that's going to meet my hurdle for a rate of return. My hurdle is typically 5 to 6% a month. So if I'm making more than that, I'm very happy. And if I've made a significant amount more than that, then I will cut the position, take the profits, and roll it into another trade. Now, I did mention making weekly income. So the way you do this, the way you want to make weekly income on your leap option is by selling covered calls. When you sell covered calls, you collect premium. But wait, Henry, don't I need to have 100 shares? Well, no, you don't need to have 100 shares. And that is because this leap option right here actually acts similar to stock. Because the delta is so high, it's 0.82, your broker will realize that this option is similar to having stock. And you don't have an unlimited risk because you're long a call option. Now you can sell a call option against this long call option. However, you don't want to wait until January 19, 2024. So you want to pick an expiration date that is going to be expiring pretty soon. So June 24th will be about 1 week until expiration. Let me go into sell call option. Now I'm going to look to sell call options on a weekly basis, but I don't want to be too close to the money, because what can happen is if I sell an $8 call option and all of a sudden the stock goes above $8, then I'm in a rough situation where I have to either close the call option for a loss, end up rolling that call option and potentially taking a loss. Instead, what I like to do is I like to go out of the money. Instead of taking the $8 strike or even the 8.5 strike, the $9 strike is much safer. It has a 90% chance of profit, okay? And if I expand this option right here, the delta is only 0.12. So 88% of the time you're going to be winning, which is even higher than the delta of the leap option. And 12% of the time you're going to have to roll, which I have a video on in the description, or you're just going to have to close for a loss. Now, let's go and sell this $9 call option. I'll tell you why this $6 premium is actually a lot more exciting than you may think. So you may be thinking, well, $6, that's nothing. I can't even buy a Chipotle burrito. However, a $6 call option is actually pretty interesting because you're only paying about $400. So a $6 call option, which you're selling, is actually 1.5% in 1 week. Now, you may not have thought of that, but this $6 premium that you're collecting is actually a very significant amount. 1.5% a week is 6% a month, or 72% a year in premium that you're collecting. And there's a few ways to manage this position. So right now, you can see the chart has become very, very wildly different. Your max profit is now capped at $113 because if this call option were to go up, you stop making money at $9 per share. However, there's a very high chance that that's not going to happen in 1 week, and 90% of the time, you're going to end up just collecting this $6 worth of premium. Now, if you were to do this over a 1 year period, $6 per week times 50 weeks roughly is going to be $300. Now, this leap call option will actually maintain its value so long as the stock ends up running up a little bit. So if the stock were to go up slightly, then your leap option is going to maintain its value, and you don't have to keep selling a $9 strike. In fact, let's say in the future that the stock goes up to $9. Well, what you can do, and let's say in the future it's maybe September, something like that. Well, if it goes up to $9, you can start selling out of the money call option still at $10 or $11, right? So you can go with the stock's flow. You can follow its momentum. So as the stock continues to rise, you can continue to raise the strike price at which you sell covered call options or leap covered call options. That way you can keep up your income, and in most cases, if the stock ends up rising, you'll actually make money on your leap option, and you will make increasing amounts of money on the call options that you're selling. And that's because a more expensive stock is going to have more expensive premium. Think of it in the case of Tesla. If the stock is $600 per share, well, even a $700 call option is going to have like $1,000 worth of premium. So in many cases, this strategy right here is going to help you make a lot of money in terms of premium, but also capital appreciation and increasing amounts of premium over time. This is why this strategy is so amazing for a small account portfolio, because the total initial cost is only $408, and you can potentially grow this $408 into $800 or more. So in the example of Palantir going up to $15 per share, that is going to be a gain of $10. So you can have a 2.5x return on the LEAP call option, and along the way you can also collect some premium from selling covered calls. Now I do want to be honest with you, sometimes you may come across that you have to roll or take a loss on a call option that you have sold. However, in this strategy over the long term, you're most likely to still collect a lot of money over time, even if you have a loss 1 out of 10 times, because that 1 out of 10 times loss on the covered call option isn't going to be such a big deal, since you are long a call option to begin with, and then rolling that covered call into another strike price won't be that expensive, or just taking a loss and closing it may oftentimes just cost you 10, 20, or something like that, something really, really low in comparison to the amount that your call option is appreciating. Now, the reason for that is because this delta right here of this $5 call option, again, was 0.82. So when the stock goes up by $1, you're making 82 cents. All right, so now that you have seen an example, I want to go back to Apple. How would I manage this trade? How would I go about potentially closing this trade, adjusting it, rolling it? How would I actually manage the position from the very first moment of opening it and everything in between until I actually close that position? Well, managing and closing the risk associated with the poor man's covered call assignment is the most important thing that you have to know with a poor man's covered call. It requires careful attention to market conditions and an understanding of option trading strategies. So, although the poor man's covered call is amazing for small portfolios, it is actually the most complicated strategy, or one of the most complicated strategies, because it does require you to properly manage the position. The poor man's covered call is more complicated than just a regular covered call, as the LEAP option does serve as 100 shares, and it's very similar to 100 shares, but it's not identical. And here are some ways to manage and close risk associated with this strategy. So number one, you can see that I currently have 140 call, and I have sold a 167.5 call. This 167.5 call is going to expire on 5/12, which is about 30 days. It doesn't really matter when you're watching this video because it's always relevant. So what you want to do is you may want to potentially adjust the strike price. One way to manage risk in a poor man's covered call assignment is to adjust the strike price of the short-term call option as the market moves. So if the underlying asset price increases significantly, the investor may want to consider raising the strike price to capture more profit. Here's what I mean by that. So let's say that in the next 2 weeks, Apple ends up going up and it increases in value, which is actually a very good thing. You can actually see here based on the chart, if it increases in value, that's very good. You're going to be in this green zone making money. So it's going to increase, but right here at 167.5, you are starting to get diminishing returns, and actually it's going to go in the opposite direction because your short covered call right here is going to start losing money. It's basically in the money. So you may have to buy it back. So what you want to do to adjust this position is if it goes a lot beyond 167.5, you will want to look into rolling this position and adjusting the price. So rather than having 167.5, because that's kind of as much money as you can make. If it goes to 167.5, you can't make any more money. You're going to start losing money. You're going to start giving away some of your profits in the poor man's covered call example. But what you may want to do with the poor man's covered call is if it does end up increasing in value, then it is actually pretty simple to just roll this position. Now, I can't actually roll this position because I don't have it open, but I'm going to show you a position that I do have open where I can roll that position. So what I'm going to do is I'm going to look at BABA, and BABA is actually a fantastic example. I've already actually rolled BABA, and I've made really good money by rolling it before. You can actually see here, I have a BABA covered call roll. And this is going to be very similar, and I've done this many times for covered calls, and it's very identical to a poor man's covered call, which I've also done many, many times. So what you're going to want to do, for example, is BABA is currently $103 per share. I sold the $89 call, so for me, I can't make any more money. If BABA goes up, then I'm not making more money. It's basically stalled and it's halted at $89 per share. But I do want to profit as BABA rises. So say I'm bullish, which I am bullish on BABA. So say I want there to be more gains, but I'm capped at 89. What do? Well, this is actually where you can adjust the strike, and this is where rolling comes into play. You can roll the short-term call option. So rolling the short-term call option involves closing out the current position and simultaneously opening a new position with a later expiration date and or a different strike price. For me, this is best practice. I love rolling out and up. What that means is I am rolling out to a future date and I'm rolling up to a higher strike price. So currently you can see that I can click this roll this position button, okay? Doesn't matter what broker you're using. Now, if I go to a future date, so you can see here that this option position expires on April 21st. So all I'm going to do is I'm going to pick a date that is more out. So say instead of the 21st, I'm going to go for the 12th, the following month. So that's an extra roughly 2 weeks. We'll actually see when I click into these positions. You'll actually see as I set up this position. Now, the current strike price is 89, but I want to make more money. Now, I may not be able to roll all the way up because BABA has increased in value significantly. This is actually a perfect example of how to roll and how to manage a poor man's covered call, because this is the same thing. BABA has increased in value a lot, and this is basically the most dangerous position that you can be in with a poor man's covered call, because you basically have to ask yourself, how do I manage this position? What do I do with a short call? Because the long call that you have is doing fantastic, but the short call that you have sold is not in the best position. It's actually in the money, and it can be in the money by a lot. So for me, I am in the money by about $14 at the moment. So if I go up to about 104, which would put me out of the money because it's currently 103 per share, this is not going to be enough to compensate me. In fact, you can see here how I would be losing $8,150. Now, granted, I would step up my basis or my cost basis on the stock from 89 all the way to 103. So I would be making pretty decent income here because I'd be rolling so high. However, I don't really want to pay a debit spread up front. So what I'd rather do is I would actually rather still be in the money, but I don't want to be at 89. So for example, I can go from 89 to say 92, okay? If I click 92, you will see that the total debit is 1,000, which is still a cost. But you can see I'm going from 89 to 92. I have 10 contracts. That's 3 times 10, 300 times 100, because each option is 100 shares. So I'm basically making 3,000. I am paying $1,000. Yes, I'm paying a debit, but I'm stepping up my capital in the stock. I can keep now 92 per share rather than $89 per share. So I'm getting $3 extra. I'm paying $1,000, but I'm cleaning up or I'm clearing up the amounts of $3,000. So I'm paying $1,000 to make $3,000. That's a 3x return, which is beautiful. And if I can do that on a very consistent basis, as the market goes up, you are going to be making a lot of money. Poor man's covered calls have the ability to multiple X your portfolio. I've seen people 50x their money with poor man's covered calls, especially when the market has a very steady uptrend. Now, we don't want a lot of volatility because the poor man's covered call actually does not do so well when there's a lot of volatility, because rolling isn't always profitable, but rolling is a fantastic way to close a current position and simultaneously open up a more profitable position, or close a position that you are profitable on, but you want to keep the gravy train going and make more money on it. Then rolling is phenomenal. It's actually a good strategy to know in general whether you're losing or you're gaining on a trade, because if you're losing, a roll can help you fix and make more money by collecting more premium, or if you're winning, then you can pay a small debit to give yourself the ability to make more money on the upside if the stock continues to rise. So that's exactly how I would close out a position. If the underlying asset price moves in a favorable direction, the investor may choose to close out the position entirely. But you can also hold until expiration if it's not in the money. So say that at expiration, BABA actually falls down to 91, which would mean that this would be an out of the money option now because I have sold at 92. In that case, I'll just let it expire for a full gain. And I won't be upset that the stock fell because I'm still making really good premium by selling covered calls. So for example, although BABA could fall, let's say, by $12 per share, I've collected $13. So while all the stockholders have lost a lot of money, because this is an in-the-money poor man's covered call, I'm actually going off as a huge winner because I've still made money even after the stock ends up falling. And that's the beauty of selling in the money covered calls. Now I've also been asked about using stop loss orders. A stop loss order is in order to sell the leap option or buy back the short-term call, or both, just entirely closing out this position. And that is what I recommend doing. If you have had a gain as a poor man's covered call, there's nothing wrong with just closing out the position entirely, because if the stock moves up by, say, 5%, your long leap option may gain 10 to 15%, and then your short call option may actually be breaking even. It might have done absolutely nothing because time decay is working against it. So in that case, if you made 15% when the stock moved 5%, there's nothing wrong with closing out that position and taking a gain and a profit. But for me, I don't love stop loss orders, but with a poor man's covered call, having this measure can be wise. But it also gets tricky because if there's a lot of volatility, you may falsely get stopped out of your position by accident for a loss, and the market may neutralize by the end of the day. I mean, it's happened to me all the time where I had stop loss orders and I get executed, and then the market just completely turns the other way around. So for those reasons, I really like to manage poor man's covered calls myself. And you're probably wondering, why don't I have poor man's covered calls? And that's because at this time, I have so many positions that are spreads that I enjoy more, covered calls, selling puts in the wheel strategy. And those strategies are less management than a poor man's covered call, which is the most management right next to a butterfly strategy. But I do want to say closing out a poor man's covered call is extremely important if you want to be profitable with this strategy. And I do think it's one of the best strategies for a small portfolio. So here's another tip to close out a poor man's covered call properly. Just buy back the short-term call option because the leap option itself does not have that much movement. So for example, we're going to go back to Apple. We're going to pick the 145 call option. This has a 77 delta, and notice that the theta is 0.035. And that is actually not that much. That's $3 a day. Now, $3 a day is certainly not nothing, but compared to $3,175, $3 is a very small price to pay daily to own 100 shares of Apple. Now, Apple would just have to move by 3 cents for you to keep breaking even on this option for it to cost you nothing. So if Apple moves 1%, which would be about $1.64, this position would actually increase by about $1.64 multiplied by the delta. So delta actually measures how much an option changes. So if the stock changes $1, this option is going to change by 77 cents, which is actually a very big increase considering that you're only putting up, again, $3,000. And because you're putting up a 1/5 of the price and you're getting 77% of the same movement. So you're putting up just 20%, but you're getting 77% in movement, which means that you are leveraged. And that is why people trade options to begin with. And it's also why I think the poor man's covered call is such a powerful strategy, especially if you do your technical and fundamental analysis correctly. In my Discord community, I'm always looking at technicals and fundamentals because if I can get that right, and I can be right in the option, there is a lot of reward and a lot of profit that you can make. And for example, if Apple goes up by $5, this position is going to increase by about $3.50. But the short covered call may not increase in value at all because time decay is working against it. If your short call option is 30 days out and it takes roughly 30 days for the stock to go up by 5%, that means that short call option is basically going to also decay. So you can make money on the leap that you buy and the covered call that you sell, which is the perfect scenario for a poor man's covered call. It doesn't always happen that way. You need a stock to steadily go up. If it falls down, then your leap option is going to suffer pretty badly, but your covered call that you sold is going to expire worthless, meaning you're going to completely collect the premium on that call option, which is a good thing. The poor man's covered call is a bit hard to track because there are 2 different expiration dates. The leap option is usually going to expire, I would tell people, 6 to 12 months. So 12 months is perfect because the theta is super low. That leap option is basically 100 shares and it's not decaying very quickly. If it's very short term, say that you bought a call option for like 1 month out, that's basically just a spread. Now, I want to point out how to pick a stock for a poor man's covered call because, frankly, if you pick the wrong stock, it really doesn't matter what fancy strategy that you use. It's not going to work unless the underlying stock does the thing that you want it to do for the underlying strategy that you're using. So first of all, let's talk about the most important thing in profitably trading the poor man's covered call strategy. It's volume. You want to pick a stock that has a healthy volume. So Apple has a decent volume. I mean, the open interest is 13,757. Now the volume is 30, but that's because I'm making this video on a weekend. If you look at the open interest, that is a very big indicator of the liquidity of the stock. So because the open interest is 13,000, I think anything over 500, frankly, is pretty good. That means people out there are trading it. There is enough open interest and volume. That's fantastic. That is going to lower your cost of trading because so many people don't realize this. Although it might be free to trade on Robinhood, you are still competing with the bid-ask spread. It's still a cost to you because you can't just buy at $31.50. I mean, try it. You usually don't get filled at the bid price. You usually get filled for somewhere in between the bid and ask. So first of all, you want to make sure that you're trading options that have a tight bid-ask spread. You want this to be close because when it is, that means you're not spending so much money in fees, essentially. This is a market-making fee. That's actually what I did on the New York Stock Exchange. I worked with market makers, people who scalp the market and make money in large quantities. Maybe they're making $1, but they could do that 10,000 times. So you really don't want to make those guys rich. You want to get rich. And my suggestion to you is you pick stocks that have high liquidity and you want the volume of options traded to be high. In fact, it's pretty much the most crucial factor to consider when implementing the poor man's covered call strategy. Volume represents the number of contracts that have been traded for a particular option on that day. Options with high volume are preferred for this strategy as they indicate a larger pool of buyers and sellers, making it easier to enter or exit a position without impacting the price too much. In contrast, low volume options are less liquid and may be difficult to buy or sell. So when you end up selling it, you may not be able to get the price that you want, and you may have to end up selling your option like a fire sale, which would be really bad for your cost. Moreover, low volume options often have wider bid-ask spreads, which I just covered, but that is going to increase your trading costs overall. But here's some other factors that I also look for. Volatility. Stocks with moderate volatility are generally preferred as they offer the potential for price appreciation without the excessive risk. Because again, when you're selling a call option, you may have excessive risk on a very volatile stock. But if there's no volatility at all, then basically you're not going to collect much for the poor man's covered call strategy. So for the poor man's covered call strategy, you really do want to pick volatility that is medium. Now, a lot of people in my Discord will ask me, like, what is medium? Well, if you look at Coca-Cola, the implied volatility is like 16. If you look at Tesla, it's 69, which is fairly high. But Apple right here is considered medium. I mean, 30 is very medium to me. Somewhere between 30 to 40 is perfectly fine. Now, also, we do want to consider dividends. Stocks with a moderate to high dividend yield can help increase the income generated from the strategy, which is the main objective of the poor man's covered call. The only thing is, when you have a leap option, you don't actually collect the dividend yield. So what you may want to happen is if your leap option goes into the money on a dividend yielding stock, you may actually rarely want to exercise. Now, I'm fairly against exercising, and it is a case-by-case basis. But if a stock is about to pay a dividend, that may actually be worth it to you, especially if that leap option is actually not that far until expiration and the time value is lower than the dividend. So you really want to pay attention to the dividend yield, especially if it is a high-paying dividend yielding stock. And then last, I really like to look at fundamental analysis. So consider the company's financial health, the growth prospects, and the competitive landscape. Because a poor man's covered call, you really don't want it to be too volatile, and it's also a bullish strategy. So you don't really want the stock to decline and pull back. As someone who's worked for Goldman Sachs and scaled my options portfolio to $2 million, I can say that I heavily focus on high quality stocks with good fundamentals, especially when I'm implementing the poor man's covered call strategy. Having worked in the financial industry for a significant period of time, I've learned the importance of fundamentals in selecting stocks for any investment strategy. With the poor man's covered call strategy, it's crucial to select stocks with stable financial backgrounds and growth potential to maximize returns and minimize your risk. Because at the end of the day, having a really high return is not that good if you have a high risk at it. If you have a high risk associated with that return, it's just not sustainable. By selecting the right stocks for the poor man's covered call strategy, I've been able to generate significantly higher returns while minimizing my risk. This strategy, along with the wheel strategy, has allowed me to grow my option portfolio past $2 million. I've also relied heavily on spreads. In fact, I think spreads are the key to growing a small option trading account. That's why the best videos that you can watch on my channel is my playlist right here, which includes both of those strategies.
Hey, this is what I do almost every weekend, shopping real estate. You're probably not going to start with that deal right there or the one that I'm standing inside of right now, Sunday morning. But you need to start somewhere, okay? In about a week, or less than a week actually, I'm going to be doing a live training for free, show you how to get started in the real estate game. I started exactly the way I'm starting right now, with walking properties, looking at deals, hanging with my wife right there, underwriting deals, checking out locations. It's so simple to do this. You don't need money. You don't need credit. You just need to start. And I want to show you how to start. It's completely free training. Take about 120 minutes of your time, and I'm going to put you in the game, I guarantee you. Click the link below. Register. This will be sold out like everything else I do. I'd love to have you be there to start your real estate career. Okay? Or continue with your real estate career. I'll show you some tricks you've never seen before. How to buy with no money down. How to get a loan below market. And how to ensure that your first deal makes you at least $1 million. That should be your goal in your first deal. Should make you a millionaire. Imagine that, okay? Spend 120 minutes with me, and I'll show you how to put one deal on the books, your first deal, or your second deal, or your next deal. Oh, man, this neighborhood is fantastic, isn't it? I mean, look at this. All I'm doing is hanging with my wife, shopping real estate. And I'll know when I see a deal, a certain number of units, certain amount of rent, certain amount of upside, how to get the loan done. Like, I simplify this game so easily. I started with $3,000. My first $3,000 turned into $6,000 at 100% return. I was like, oh my.
At the stop sign, turn right onto Gillespie Street.
You're telling me where to go right now. My first $3,000, I made 100% return in under a year, and I was like, I'm on my way. It wasn't a lot of money. But I knew I was on to something, okay? My second deal, no money down. Check this out, no money down. See, look at this little house right here. Somebody's going to make a fortune on that little house right there.
In a quarter mile, turn right onto Cedar Springs Road.
My second deal, I put no money down. I made $32,000. My third deal, I put $300,000 down and made $5.2 million. But check this out. And I'll be sharing this with you, how I took one deal, I owned it for 3 years, I made $144 million non-taxable, $144 million, and I paid no taxes. I'll show you how to do all that. Click the link below. It's completely free, no strings attached. You don't have to do anything. Just show up. I'll do the rest.
This thing? It's what's going on inside of me. It's my moderate to severe ulcerative colitis. It wasn't always this calm. UC went everywhere I did. Wondering when it would pop up next was stressful, doing a number on my insides. But then I found out about Velsipity, a once-daily pill, not a steroid or biologic, for adults with moderate to severe UC. Velsipity can help calm the chaos of UC. It quickly treats flares, providing a chance for lasting steroid-free remission. Don't take Velsipity if you've had a heart attack, chest pain, stroke or mini-stroke, heart failure in the last 6 months, irregular or abnormal heartbeat. Velsipity may cause serious side effects, including infections that can...
Spread trading, the ultimate guide to scaling a small option portfolio. In this video, we're going to be talking about taking a limited risk with a small amount of capital and getting a lot of money back with a high probability of winning each trade, and how to actually make that a consistent trading strategy. For me, spreads is literally like the ultimate way to growing a small portfolio. When I started with just $2,000, I grew my 2,000 to 7, then 17, and then over a number of years, I finally got in the past the 7-figure amount. And spreads are literally a very big part of that. As you can see my portfolio right now, I have Alibaba spread, I have Nvidia spread, I have QQQ spreads, SPY, I have a number of spreads that I am currently in. And I'm going to explain to you how you can use spreads to not only manage your risk, but also just hit all of your trading objectives and make a consistent weekly income. First of all, I love taking a limited amount of risk because nobody wants to risk everything that they have on one position, or a lot of people are restricted because they don't have big portfolios, and that's totally okay. That's where spreads really come into play. You don't need a lot of money. In fact, anybody can use spreads to grow a small portfolio into 5 figures, 6 figures, and even 7 figures. Now, spread trading allows you to limit your risk by placing trades that profit from both up and down movement in the market. This means that even if the market goes against you, your losses are limited when you are using spreads. Most of the spreads that I am playing are only using about $300. As you can see right here, I am playing a $300 spread on Alibaba. I've already made $22, and this is a position that I opened this week. So the return potential on spreads can be 5, 6, 7% in a week, and in a single month, you can make 20% and higher. For me, I love using spreads because they are a very consistent strategy. Spread trading is a more consistent way to make gains compared to other strategies that may be more volatile or require higher risk-taking or higher amounts of capital. This makes it a great option for those who want to build a steady stream of income from trading without having a lot of money to trade with. In this video, I will show you examples of opening, closing, managing, and profiting from spreads. My trading objective is always to make money and go after growth safely. I never want to risk too much of my portfolio, and I never want to experience a lot of volatility. In fact, if I go to my year-to-date returns, I'm not up a lot, but for me, it's a very consistent amount of money that I can make every single month, 2 or 3% per month on a larger portfolio. Now, obviously, when I had a smaller portfolio, I was chasing 20% gains per month. And I think it just depends on your risk tolerance. I'm going to be showing you how you can make a lot of money, but I'm also going to be showing you how you can manage your risk. Everybody's trading objectives can be a little bit different. Some folks are closer to retirement and they're going to want to have a more consistent and steady return. If you don't have a lot of money to work with, you're a little bit younger, or you're a little bit earlier in your trading career,
Robinhood Gold gives a VIP treatment for all. Earn 5% APY on your uninvested cash.
What if there was a way to know if a stock will be bullish or bearish the day before? The truth is, there actually is one way.
So your trading account's suffering right now, but you're wondering, what do I do to start winning consistently and start making those big returns you've seen other traders make, the returns that you know are possible? Here's the honest truth. I struggled like that for a while. Trading did not replace my job for 15 years until I basically had a stroke of luck. My cousin, who's a professional stock trader, making over $2 million a year, finally had me over to his house and show me some behind-the-curtain stuff, so to speak. I know that sounds a little storybook, but it was quite honestly the missing piece I needed to get to the next level. I was a decent trader before that, but once I learned to look at a specific set of market internals every day, which I call the Market Weather Report, that's when things really took off for me. I'm actually a chef. You can look me up, Chef Michael Love. But I love trading, and I got tired of the hard work and long hours of being in the kitchen. When I finally cracked the code of trading, I was able to quit my job as an executive chef in Miami and trade full-time. I started Trade With Me Now because friends and family were knocking my door down, asking me to trade for them or text them what I was doing. It all just became way too much. So on the suggestion of a friend, I started this company to help other people make money trading and to make some money in the process myself. So every month, I send out on average 20 to 30 trades to our members. These are the exact trades I'm taking in my own account day in and day out in real time. Our members get the trade right before I take it. Every alert includes the ticker, the expiration date of the option, the price you should grab it at, and why I'm taking the trade, everything. Then I send out a text when you should get out of the trade. And it's also the only two-way trade alert service out there. That means if you have a question about the trade, you can just text back and you'll get an answer from me personally. Please let us know if you see this from any other service, because we're yet to find it anywhere else. It doesn't matter what level trader you're at. If you're a brand new beginner, you can start just following the trades within the first week or two. And here's the best part. When you join Trade With Me Now, you get 30 days of text alerts included, so that you can try them out and make sure they're profitable within the first month. This is truly the fastest way to trading success, with none of the pain of trading in the dark and spinning your wheels for years. Listen, don't take my word for it. We literally have a full wall of hundreds of these testimonials from members, and they're all unsolicited. I obviously don't have enough time to go through all the member reviews here. Click the button below to see the whole offer and get started today.
Then you may not mind to go for higher returns at slightly higher risk if you're only trading a few $1,000s. Consider why you're trading options and what you hope to achieve. Are you looking to just generate income, protect an existing position, or are you trying to speculate using options? For me, I'm always trying to generate income. That is the way I teach. Most of my students in my Discord community are making from a few $100s a month to a few thousand or even tens of thousands of dollars a month. Spreads is a big component of that. Different spreads can be used to achieve different objectives. For me, I love using credit spreads. Credit spreads is where you're collecting premium up front. However, some other folks want to have a bigger return and they go for buying spreads, which is called a debit spread. For example, you can see right here that I have a BABA put credit spread. This is an 82.79 put. This right here is a put credit spread that is going to benefit if BABA does not fall below 82 by the expiration date. Now, this option is expiring in 2 days, which basically means that it's not going to be in the money. This is going to be a successful position. And as you can see over here, I have sold a put option on BABA, and this has also made me $630. I've done this on DocuSign and right here on NVIDIA. And I will cover this iron condor right here. This iron condor is actually a combination of two different spreads. My two favorite spreads are a put credit spread, which is right here on BABA, and a call credit spread. I actually have a lot of call credit spreads right now on Netflix. My group and I have made a lot of money on Netflix, and I am bearish on Netflix. I don't necessarily think that Netflix will fall, but I have so far made $600 and $260 using call credit spreads, which I will open up and show you an example of how to open, close, manage, and profit on a position like this in just a moment. But Netflix is a stock that I think is fairly expensive. But check it out. When you sell a call credit spread, you don't necessarily have to be right on the stock going down. In fact, a stock can slightly go down, stay the same, or even rise a little bit, and you will still end up being profitable on a call credit spread because it is an out of the money option. Right here, as you can see, it's 370 or 390, 395. All of these are very far away from the current price of Netflix, which is around $305. For me, my go-to are credit spreads. The primary difference between a credit spread and a debit spread is that a credit spread collects money. So I'm always collecting this income up front. So if I open up this Netflix call credit spread, I sold each contract on average for $41. So I collected $41 up front, and I only risked about $460. That's because this spread has a $500 difference. However, because I collected 40, it's not really 500, it's only 460. So I'm collecting $40 and I'm only risking 460. That might not sound like a lot, but that's almost a 10% return. And on that 10% return, I'm not really risking all that much. I'm risking a very small amount. And also, if you think about it, if I open this up right.
How do people feel about getting a Planet Fitness membership for $15 a month? Get access to tons of equipment and find your big fitness energy. Join Planet Fitness today through the free PM app online or in club for just $15 a month.
Your future is at your fingertips. Take advantage of the flexibility and diversity of futures trading with NinjaTrader, the #1 rated futures broker. Start trading futures today.
Right now, the delta, although this position has eroded a lot and the delta has definitely decreased. In fact, this delta is extremely small. But when I opened this position up, the delta was tiny. And a small delta is very good. That means that there's a small chance of the stock going to that price, okay? So if there's a small chance and you're selling the option, then you have a big chance of winning. You have a huge chance of winning. With a debit spread, it's very different. You're usually paying money to do something. So for example, if I open up QQQ and I go to trade QQQ options, a debit spread would look like this. I would buy a option that is into the future, let's just say about 23 days out, which is 3 weeks. If the current price is $296, let's just say I go up a little bit and I buy a 305 call option. And then, I'm buying one option. This is a call option. And now if I end up selling the 310, this would be a call debit spread. I am betting that the stock will go above 305 and not higher than 310. Although it could go higher than 310, just I won't make any more money. As you can see by this payoff chart, I am betting that this position would rise in value and I would make money. So as this position rises, I would make money up to $354. So I can more than double my money on this trade right here. However, this stock or this index fund QQQ, triple Q, would have to rise above 306.46 for me to start seeing money. Now for me, this is an okay position to have. It certainly has a high return, but it's not necessarily a high chance of profit. This is not going to happen all the time. In fact, if I open up this 305, about 1/3 of the time I will end up winning, which is not too bad. But in the Netflix example that I just showed, my chances of winning were over 90%. So I can win 90% of the time with a credit spread versus a debit spread that will win about 33% of the time. So for me, credit spreads are much more profitable because they're more consistent. And I prefer to sell options than buy options. For me, when I used to work for Goldman Sachs, I've done a lot of research. I would spend a lot of my time just researching the market, but also researching strategies. There was a lot of information at my fingertips. And one of the pieces of information that really changed my life is learning that selling options was way more profitable because most people lose because they're buying options. Similar to a casino, most people are going out there buying options and it doesn't end up being profitable. That is just the statistics of option trading. It's very common that it is not profitable to buy options. And it is profitable perhaps before earnings. Sometimes you can buy call options like leap options, that could be profitable. But in most cases, when people are buying call options that are out of the money, short term, about 80 or 90% of the time, those options expire completely worthless. And the person buying those options ends up losing all of their money, or at least the money that they paid for buying that option. For me, I prefer selling options because I can win 90% of the time. And honestly, option trading is like a game of chess. You need to think several moves ahead and anticipate your opponent's next move. Just like in a chess, it takes practice, strategy, and patience to be successful in option trading. And for me, I always want to successfully look at the technicals and fundamentals of a stock. And I will be covering technicals in this video shortly. I'm actually going to go and pick a stock like Apple and then show you what the technicals look like on Apple and what I would be doing in terms of a spread. And while I load up Yahoo Finance, I just want to say that it is really important to also understand your risk tolerance. For me, I like selling options because my risk tolerance is not that high. For me, I really do depend on this money right here, this $2 million. If it can generate me even 2% a month, that's a significant amount of money. That is a very large amount of money that can fuel my lifestyle, to travel, to basically live off of. And I'm sure for a lot of you, you guys would like to get to the point where you can just trade and have that be your primary source of income, so you don't have to work a 9-to-5 job or be a business owner or, have any type of work that you have to be committed to. For me, option trading takes about 3 hours a week and it generates enough for me to live off of. So for me, it's very important that I manage my risk very well. In fact, that's one of the key indicators to a good trader versus a bad trader. A bad trader may make a lot of money short term, but in the long term, he ends up either leaving money on the table or ends up having a really huge loss. And I've seen that over and over again. I had a student that actually had about $40 million. He had, tens of millions of dollars, and it was all in Tesla stock. And I had told him to cut his position, didn't listen to me, and he ended up losing most of that money. He was still a millionaire, but he went from like 40 million all the way down to like 10 or even less than that. his exact situation was complicated as he had many portfolios, but that is an example of somebody that does not understand risk management. It kind of blows my mind because the person was so wealthy. You are so set at $40 million. It's ridiculous how set you are. You can have anything that you want. There should be no reason that you should be high risk if you have that amount of money. But honestly, even if you have a small amount of money, you still need to understand your risk and return profile. You still need to understand risk management, which I will definitely be showing you, because if you take too much risk and you end up blowing up a $2,000 account, well, that sucks because you probably worked really hard for that $2,000 or $5,000 or $10,000. And it's not so easy to just fuel your account again with $5,000 or $10,000. It certainly was not the case for me when I first started trading. Back when I was, 19 years old, it was like 2014. This is almost a decade ago now. I was working on Wall Street and I just didn't really understand at first. So luckily I did not blow up my account, but it's very easy to do so. The safest strategies are still going to be those large account strategies like covered calls, selling puts, but still spreads are fantastic and they are the ultimate key to growth. Now for me, I wouldn't put all my money in spreads, certainly not with a $2 million account, but if you have 5 or 10 grand, then putting a lot of your money into spreads does make sense. It's not that much of an issue as long as you are diversified.
Metro presents a tale of two wireless customers.
I've been a loyal customer since today.
Forever.
Which means I get all the deals.
Absolutely no deal.
It's like they totally see me.
Forgot I exist.
That's such yada yada.
I hate yada yada.
But now, with Metro, existing customers can get the same great deals as new customers.
Finally, introducing Metro Flex. Get that new customer feeling again and again. Free 5G phones when you join, and the same great deals as new customers when you stay. That's not a yada yada. Only at Metro.
Neutrogena Collagen Bank. Stronger collagen, plumper, glowing skin. Start banking with Neutrogena today.
Now, option trading and diversification, it's all very similar to all the games of life, like chess and poker. You need to calculate your risks and be prepared to walk away from the table when an opportunity is just way too risky. And you also need to diversify and have many small positions that contribute to a bigger income. So if you have 10 positions, each making you $200 a week, fantastic. $200 a week, 10 times is the way to go versus one position that you're making $2,500 on. Sure, $2,500 is more, but it's not that smart. It's much smarter to have 10 positions making you $200 a week. Now, for me, as you will see right here on the right-hand side, a lot of my trades, the length of time that I like to go for is 1 to 6 weeks. So for BABA, this is 2 days away from expiration. If I go out to another BABA, it's out to 2 weeks. More 2 weeks, right? 317 expiration. And then from 317, my portfolio is going to jump into 421, which, there's a reason why I'm doing monthly trading. A, it's less time. B, if everything expires on a similar day, then I can be more prepared to really understand and pay attention to that day of expiration, right? So I can prepare on that Friday to roll if I need to, close out positions if I need to, adjust them as needed. And then also keep in mind, options are traditionally expiring on the third Friday of every month. So that third Friday is still, because it's traditional, we'll still have more volume, more open interest. And that is very important. That's liquidity. Liquidity is super important for trading options, by the way. So, for example, a stock that I really like is Chipotle, and I've been wanting to trade spreads on Chipotle for a very long time. So if I show you how to trade spreads on Chipotle, you're going to see a very big fundamental problem of why I don't. So if I go to sell put option and I go to the traditional, let's actually go to the April 21st, give you guys some time in case you're watching this in the future. All my videos you can watch in the future. So check this out. Let's say that I'm bullish on Chipotle, which I am for the most part. I've been liking Chipotle for a very long time. One thing that Wall Street really taught me, and something that I learned in my finance degree when I was at Drexel University, was that essentially looking at same store sales is very important. For example, like if you look at McDonald's as a company, they're opening up so many stores, which is cool, right? They're growing their amount of stores. But what's really important to me as an investor, especially because I have a lot of experience in the technology space and the consumer space. So something like Chipotle, what I like to look at is same store sales. Are people coming back to the store and, buying more of that good, that product, the service, or, the consumable, right? So for Chipotle, it's a consumable, it's a restaurant. So are people going to the restaurant and eating there more often or less often? And the trend with Chipotle is really good. So So check it out. I'm going to go ahead and open up a spread. So for example, sell put. I'm going to open up the 1450 spread right here. Okay, if you will notice that this is basically, unfortunately, very bad. There's just so many bad things about this option right here. First of all, the volume is 0. Like, that is as bad as it gets. Like, nobody has traded this in the whole entire day. And considering that it's 2 p.m. on a weekday, right? The market's open 2 p.m. Eastern. This is bad. I mean, the whole day has gone by and nobody has really opened up any contracts here. So the volume is 0. Very, very bad sign. The open interest is 14. I mean, just 14 contracts open. So this is just right off the bat, awful and terrible. And then if you look at the bid-ask spread, this is what I mean about liquidity, guys. Liquidity is super important when trading options. In fact, sometimes liquidity can mess up your option position altogether. It doesn't matter if you're right on the direction. If the liquidity sucks and you get a really bad price, like, you are doing yourself a really huge disservice. Like, you're just paying way more money than needed. As you can see right here on Chipotle, for example, I'm going to open up this full put credit spread, but right here the bid is $24.90 and the ask is $26.20. Like, that is very wide. That's $1.30 difference. Like, you're basically getting charged something in between, right? Let's just say it costs you $70. That's $70 worth of cost. So let's go ahead and sell this, and then the 1440. Again, you can see 0 volume. The bid and ask is $22.40, $23.70. Again, $1.30. So you're losing that 2 times. Oops, sorry. I meant to do sell put and then buy put. So first of all, to do a put credit spread, you sell one put, the more expensive put, right? This is more expensive, $24.90. So I'm going to be selling that. Then I'm going to buy something a little bit cheaper, which is the next leg down, $23.80. Then if you notice right here, I mean, this is a pretty good return. This is not bad. It's like a 1/3 return, which means 33% in 44 days. That's pretty good. In 6 weeks, you can make 33%. So basically, that's like over 20% a month, roughly. So 20% a month is really, really good. But if I go to continue right here, check it out. Check it out. Like, what would you put here? You tell me. You tell me. What would you put here? Are you going to put 240? For example, if you do one contract here, are you going to get 240 for it? Guess what? Probably not. And in fact, the platform just said low likelihood of being filled. Very low likelihood. There it is again. Low fill likelihood. And that's because, look at this bid-ask spread. It is awful. Like, literally trash. Like, $1 and $4. Like, what's the actual price? It's practically impossible to tell. So you can probably go for $2 and you still have a medium likelihood of getting filled. So the actual execution price here is pretty much unknown. You don't know what you're going to get filled for because the volume is 0. If nobody wants to trade with you, then they're not going to trade with you, and you're not going to get your position filled, and you're not even getting a good price. Even if you do get it filled, you're basically just getting ripped off. So liquidity is one of the most important things that you should not overlook. This doesn't even take a genius to understand this, but for me, I've seen this happen over and over again, and then people learn the hard way. So please, just understand, if the bid and ask spread is more than 50 cents, that's already in really bad territory. For example, I want to show you Apple. What would I do with Apple? Okay, so I'm going to open up Apple on Yahoo Finance, and I want to show you something that I do to basically analyze a stock. For me, I use Bollinger Bands a lot. So as you'll see here, this orange right here is a Bollinger Band. Essentially, a Bollinger Band is a technical analysis tool that uses a set of moving averages and standard deviations to analyze price volatility and potential price trends. This tool is named after the creator, John Bollinger, and it's widely used among traders and investors to make informed trading decisions. So I had originally learned about this actually at Goldman Sachs, but I didn't really take it seriously until I had my following job at a hedge fund where I was really focused on more quantitative analysis. And then what I really learned about the Bollinger Band is how it works and why it's so important. And basically the way you can think about this is, imagine you're walking a tightrope, okay? You want to keep your balance and you want to avoid falling off, but you also want to move forward and make progress, right? To help you do this, you might be using a balancing pole that extends on both sides of your body. If you start to lean too far on one side, the pole will push back against you and help you maintain your balance. And the Bollinger Band works in a very similar way. They are like a set of balancing poles that help traders and investors maintain balance and avoid falling off track. The bands are based on a set of moving averages and standard deviations, which act as support and resistance.
Are you trading S&P or NASDAQ ETFs? Discover futures from CME Group on the equity indices you know and love. With around-the-clock liquidity and lower margin requirements, enjoy the benefits unique to futures. Start trading today.
Levels for price movement. Okay, what a standard deviation is, it's basically just trying to measure how far is something from normal. Okay, meaning if you are 5'10" man and you have a son, your son's going to be about 5'10". If he's 6'5", okay, that means on this orange line he's probably somewhere around here at 170. Okay, that means Apple's going to go to 170 tomorrow. Probably not going to happen. Okay, because genetics, that's how it works. There's a central tendency. Okay, what is normal for those, genetics? So if you're 5'10", you have a spouse that's 5'5", most likely your offspring isn't going to be 6'5" or 7 foot. It's very unlikely. Okay. Similarly, if you're 5'10", it's very unlikely that you will have a male offspring, right? That's a man, and then that man's going to be 5'3". That means he would be somewhere down here. Okay. That's unlikely. So this Bollinger Band is trying to measure what is normal based on volatility, based on what the stock is doing and how much it's moving up and down, how much it is fluctuating. Okay, so for Apple, as you can actually see right here, it's actually somewhere in between. So if I go to the 3-month chart, you do a left click right now, 3-month chart, it's actually somewhere in between, and it's pretty predictable. As you can see here, it basically stays within the Bollinger Band most of the time, meaning that it is a very good measure of where a stock is likely to stay within. And for Apple, it's likely to be between 144 and 156. That is just what the Bollinger Band is saying. It's using math, and I'm using 2 standard deviations, okay? 2 standard deviations means basically there is a 95% chance of this option, or this stock actually, or this asset in general, to be between these 2 prices. So if I were to pick a option or a spread, I would do 2 different types of spreads. The first one would be around 144. So for example, I would go to Apple, okay? I will go to trade Apple options. Now again, this Bollinger Band is out for 20 days, 20 trading days. So that is about 1 month. So 1 month out, okay? So I'm going to go back here, and I'm going to go out 1 month. So the expiration that I'm going to pick is going to be April 6th. That's 29 days out. And again, if I go back to the Bollinger Band bottom is 144.88. So it's very unlikely that Apple will be below 144.88. So the strike price I'm going to pick is going to be 144. So to open up this put credit spread, because again, if you look, this is the bottom. So I want to make sure that I'm selling a put credit spread, collecting money by selling a put credit spread. So I'm going to go down, sell a 144. Okay, and then I'm going to go down and buy the next leg down. So this is going to be a very small position, which is great. You can collect $19 for an $81 risk. That's basically 1/4. That's a 25% return. 25% return in 1 single month. That is a fantastic return. And guess what? This is a very high likelihood of succeeding. In fact, you're going to succeed about 80% of the time. So you're only going to lose about 20% of the time, and you're going to win about 80% of the time. And right here, as you'll notice, the bid and ask is amazing. It's very good. In fact, the bid-ask spread difference is only $2. Whereas for Chipotle, it was $1.30. It was very wide, and there was 0 volume. Here, we have a healthy volume. Well, it's not great, but it's not bad. It's Apple. So, the bid-ask is great, but, I'm surprised to see such a low volume. But it's not bad. 16 means you can easily get filled, especially because there's some volume, there's some open interest. And that, again, the reason why there's actually not that much is because this is a non-traditional expiration date. If I go for a traditional one, which is going to be April 21st, and I go to sell put, let me get rid of these 2, then you will notice that I'm going to get a much better volume. In fact, you can see right here that the volume is 1,852, which is huge just for today. and the open interest is 24,000. The bid-ask spread is also very tight at just a difference of $2. Now, implied volatility is also very important. I do typically like to see implied volatility around 35 or 40. Now, this is Apple. It's a very safe company. It's a very large company, and that's why the implied volatility here is just 27.92. That's not as high as something like, potentially a Tesla. So if you were to look at Tesla, the implied volatility is going to be, potentially even double. So if I go to sell put, and then I go to April 21st, which is about, 6 weeks out, and then I look, so I currently do actually have a put debit spread. But anyways, let's open up this 165. You'll see that the implied volatility indeed is more than double Apple. So something like Tesla is going to have a lot of volatility, and that's not that bad of a thing, especially if you are selling options. If you're selling options, you can actually make a lot of money because when you're collecting premium, and that premium is larger, the higher the implied volatility is. And another thing is, I really like to sell credit spreads because it gives me a defined risk and return. That's actually how I did grow my portfolio from 2K to 7K, and then again from 7K to 17, is I took calculated risks. I didn't just buy call options, even though it was tempting to do that, but I like using credit spreads. And you can still build an account very quickly, even with safe credit spreads. Again, if you can make 25% returns in a single month, and you can keep rolling that into more trades, then you're going to get a huge return if you compound that over 1 year. 25% returns, just 10 months in a row is going to be way more than 250% growth because obviously you are compounding that growth. So it's going to be an insane return of, multiples of your portfolio, 4, 5x, 6x potentially in just 10 months. And in the year, that's how you can multiply your money from, 7K to 17. That's not that hard if you're utilizing spreads and you understand, again, these Bollinger Bands, if you understand how to use.
When it comes to paying off debt, you can save time and money. A debt management plan from the 60-year national nonprofit GreenPath Financial Wellness is designed to pay off your debt in 3 to 5 years and may result in lower interest rates and lower monthly payments. How much can a debt management plan save you? Find out by calling GreenPath today.
The new Neutrogena Collagen Bank SPF Moisturizer provides stronger collagen, plumper, glowing skin, available now at Target.
Use these Bollinger Bands to your advantage and trade outside of them. So again, I showed you on Apple, I would sell the 144. And to be honest, you can sell the 145. It's not that big of a deal. If you're right around this zone, all you really have to know is that more often than not, you're going to be very safe. And the Bollinger Band is doing a lot of work for you, basically telling you how likely something is to happen. Now, if you want to be super, super safe, then you can turn the 2 standard deviations into 3. So for example, on Yahoo Finance, if I turn it from 2 to 3, I'll keep the period the same at just 20, so 20 days. Now you'll see that the Bollinger Band has actually expanded. And if you'll notice, over a 3-month period, Apple has never gone past any of these levels in the Bollinger Band because 3 standard deviations is now 99% of the data. That's literally like as safe as it gets. I mean, you can get safer, you can go put 4, but to be honest, it's just like 1 out of a million chances. So you get super, super, super low, okay? But this is now 99%, okay? So this is meaning that you would instead of going for 144, you would go for 142. Now for me, I think 3 standard deviations, the only time that I really use it is if there's like earnings and I want to be really safe because of earnings, then I'll use 3. But to be honest, most of the time I just use 2. And I think 2 will do the job just fine. Now, as you grow your portfolio, there's some more important points about opening, closing, and managing your trades. Essentially, you want to open about 10 to 15 spreads if you're going to have a small portfolio and just deploy all of your capital in spreads. But if you have a bit larger portfolio, like me, but even if you have 100K, right? That's a big portfolio. 100K is fairly large. So if you have 100K, then it doesn't make sense to open up your entire portfolio in spreads. It's just way too risky. What you'll want to do instead is you want to have maybe 10 or 20% of your money in spreads. So if you have 100K, you might only want to put 10 grand, 15 grand, or 20 grand into spreads. You don't want to put 100 grand into spreads. Although I will say you can do a lot of put credit spreads and call credit spreads, those two are against each other. So, for example, I am doing call credit spreads on Netflix. So let's just show you quickly on Netflix what I've been doing. Fairly bearish on Netflix, and as you guys can see, I've opened up these positions in my Discord, and people have made a lot of money. Like, you don't have to have the 25 grand. Even if you put in 12 grand, 6 grand, you would have still made a pretty good return, a very good return. In fact, for example, on this trade right here, I opened up not too long ago, and it has made $250, and I have opened up 10 contracts. So this is just a 5 grand position. So this is about a 5% return. I opened this up about two and a half weeks ago. So about 2.5 weeks, 5% return. But again, for me, I'm going for safety. I'm going for consistency. Of course, you can go a little bit riskier. You can make more money than me. It's not hard to make more money than me, but I'm going after consistency and safety. And I'm trying to scale my portfolio slowly without the stress of all the volatility. So for me, I'd rather get a little bit lower return, but have a lot more consistency. Now, I want to show you what a call credit spread would look like on Netflix. So if I go out again to April 21st, okay, I would just pick something out of the money. So for example, I would go up. You can go up a lot. Currently, the stock price is 309. If I go up to like 355, boom, sell this, okay, and then open up 360, I'm going to open up a call credit spread. This is a $90 return. I'm risking about 410. Again, this is roughly a 25% return in 6 weeks. So about 4% a week. I mean, that's fantastic. Getting a 4% return per week will absolutely scale your portfolio over time, even if you don't put 100% into a position like this. But if you have a small portfolio, you can utilize call credit spreads and put credit spreads. And of course, if you want to buy some options as well with debit spreads, I'm not a huge fan of it. I don't recommend it as it's not as consistent. But what you can do is you can use the profits that you make from collecting the credits and then reinvest those profits into debit spreads. So you can start buying some options with the profits that you can make. Now, the last thing I want to say is that you can also use option and spreads to be specific to hedge your portfolio. So you can greatly protect yourself, in fact, by using spreads. So for me, for example, I identify a stock that I think is getting overheated or it's pretty expensive, and then I'll pick a strike to sell a call option. And then at a higher strike, of course, I'll buy another call option, basically what I just showed you on Netflix. So I will identify a call option to sell at 355, and then I will buy at 360, and I will open up a call credit spread like I did right here. But I'll actually use this as a way to hedge my portfolio when the market is getting very hot. Because when the market is just going up a lot, you actually have a lot of risk on the table because there can easily be a pullback. And let's say you're dealing with $10,000, even, $10,000 is not a huge amount of money, but if you're dealing with 10 grand and the market's at a very big peak, if it falls 20%, you'd lose 2 grand. But if it, rises another, from 309 to 355, that's a good 10%. If it rises more than 10%, then you may potentially lose $410. But the rest of your portfolio would significantly rise, right? 10 grand going up 10% would be 1,000. And here you may lose 410. So you would still make more money, even in the worst case scenario here. But still, this is unlikely to happen. This would have to rise by way more than 10%. And if it does, let's say the market freaking goes up by 50%. Well, okay, great. You'd make 5 grand and lose 410. You have a defined risk and a defined return. So you can't really lose more than the 412 that you're putting up for this position. That's what I really love. Versus when you buy options, you can just lose 100% of what you pay for. Here, this is unlikely to happen, especially if you manage your position correctly. For example, if this position starts to go up and it hits 355, you're not going to see a full loss of 410 yet. You can actually just close this position and, maybe just lose a couple $100. Maybe you lose 200, but you won't necessarily lose the 410, especially.
What if there was a way to know if a stock will be bullish or bearish the day before? The truth is, there actually is one way.
Is your trading account suffering right now, but you're wondering, what do I do to start winning consistently and start making those big returns you've seen other traders make, the returns that you know are possible? Here's the honest truth. I struggled like that for a while. Trading did not replace my job for 15 years until I basically had a stroke of luck. My cousin, who's a professional stock trader, making over $2 million a year, finally had me over to his house and show me some behind-the-curtain stuff, so to speak. I know that sounds a little storybook, but it was quite honestly the missing piece I needed to get to the next level. I was a decent trader before that, but once I learned to look at a specific set of market internals every day, which I call the market weather report, that's when things really took off for me. I'm actually a chef. You can look me up, Chef Michael Love. But I love trading, and I got tired of the hard work and long hours of being in the kitchen. When I finally cracked the code of trading, I was able to quit my job as an executive chef in Miami and trade full time. I started Trade With Me Now because friends and family were knocking my door down, asking me to trade for them or text them what I was doing. It all just became way too much. So on the suggestion of a friend, I started this company to help other people make money trading and to make some money in the process myself. So every month, I send out on average 20 to 30 trades to our members. These are the exact trades I'm taking in my own account day in and day out in real time. Our members get the trade right before I take it. Every alert includes the ticker, the expiration date of the option, the price you should grab it at, and why I'm taking the trade, everything. Then I send out a text when you should get out of the trade. And it's also the only two-way trade alert service out there. That means if you have a question about the trade, you can just text back and you'll get an answer from me personally. Please let us know if you see this from any other service, because we're yet to find it anywhere else. It doesn't matter what level trader you're at. If you're a brand new beginner, you can start just following the trades within the first week or two. And here's the best part. When you join Trade With Me Now, you get 30 days of text alerts included, so that you can try them out and make sure they're profitable within the first month. This is truly the fastest way to trading success, with none of the pain of trading in the dark and spinning your wheels for years. Listen, don't take my word for it. We literally have a full wall of hundreds of these testimonials from members, and they're all unsolicited. I obviously don't have enough time to go through all the member reviews here. Click the button below to see the whole offer and get started today.
Especially if you end up closing this position or setting a stop loss. I don't really love stop losses, but you can set a stop loss. Sometimes what happens is there's a false stop loss. Basically, during the day, the market can have a violent move in one direction. This bid-ask spread can get a little bit wider, and what ends up happening is you get executed getting out of your position and ends up doing more harm than good, which is why I don't really love stop losses. But you can set a stop loss for a certain dollar figure. So for example, let's say that there's a $200 loss. You can just say, hey, I'm going to buy this back for 300 if it hits 300. Most brokers have that, and it doesn't really matter which broker you're using, but you can end up setting up a stop loss. So just in case the worst happens, you can manage your risk correctly. And for me, like honestly, managing risk is super important. Risk management is the process of identifying, assessing, and prioritizing risks and taking steps to really mitigate the amount of risk you have so you can manage your positions and not ever lose, 100% of what you pay. Because that's always the worst feeling, is when you lose 100%. That's hard-earned money lost and down the sink. Many honestly think that option trading is super risky, and it is if you don't know what you're doing. But if you do know what you're doing, it is way safer than stocks. Risk comes from honestly not knowing what you're doing. And that was said by Warren Buffett. Warren Buffett emphasizes the importance of having knowledge and understanding in an activity, especially when it comes to financial investments. When you lack knowledge or understanding of the investment instrument, you may be taking risks that you're not aware of, leading to potentially harmful consequences. For example, a novice investor who is not familiar with option trading may purchase a call option without fully understanding the risks involved. He doesn't understand that 80% of the time, he's not going to end up winning. They know options are risky, but they don't know how to manage their risk. They just end up buying lots of call options, and that's how you end up flushing a lot of money down the toilet. But if you understand risk management, it's like a safety net that catches you when you fall. We all make mistakes. Anyone with a 100% win rate is just a complete liar. Like nobody has a 100% win rate. That just doesn't happen. But if you understand how to manage your risks, which is, by the way, you can also use the Bollinger Band, which I showed you. This will help you manage your risk. Diversifying and having 10 to 15 positions in your portfolio will also help you do that. Then option trading is way more profitable and better than literally every other investment vehicle that I've come across. And by the way, if you connect call spreads and put spreads, you get iron condors. And if you want to watch a video on how you can make a lot of money using iron condors, then check it out right here.
Hey, this is what I do almost every weekend, shopping real estate. You're probably not going to start with that deal right there or the one that I'm standing inside of right now, Sunday morning. But you need to start somewhere, okay? In about a week, less than a week actually, I'm going to be doing a live training for free, show you how to get started in the real estate game. I started exactly the way I'm starting right now, with walking properties, looking at deals, hanging with my wife right there, underwriting deals, checking out locations. It's so simple to do this. You don't need money. You don't need credit. You just need to start. And I want to show you how to start. It's completely free training. Take about 120 minutes of your time, and I'm going to put you in the game, I guarantee you. Click the link below. Register. This will be sold out like everything else I do. I'd love to have you be there to start your real estate career. Okay? Or continue with your real estate career. I'll show you some tricks you've never seen before. How to buy with no money down. How to get a loan below market. And how to ensure that your first deal makes you at least $1 million. That should be your goal. Your first deal should make you a millionaire. Imagine that, okay? Spend 120 minutes with me, and I'll show you how to put one deal on the books, your first deal, or your second deal, or your next deal. Oh, man, this neighborhood is fantastic, isn't it? I mean, look at this. All I'm doing is hanging with my wife, shopping real estate. And I'll know when I see a deal, a certain number of units, certain amount of rent, certain amount of upside, how to get the loan done. Like, I simplify this game so easily. I started with $3,000. My first $3,000 turned into $6,000 at 100% return. I was like, oh my.
At the stop sign, turn right onto Gillespie Street.
You're telling me where to go right now. My first $3,000, I made 100% return in under a year, and I was like, I'm on my way. It wasn't a lot of money. But I knew I was on to something, okay? My second deal, no money down. Check this out, no money down. See, look at this little house right here. Somebody's going to make a fortune on that little house right there.
In a quarter mile, turn right onto Cedar Springs Road.
My second deal, I put no money down. I made $32,000. My third deal, I put $300,000 down and made $5.2 million. But check this out. And I'll be sharing this with you, how I took one deal, I owned it for 3 years, I made $144 million non-taxable, $144 million, and I paid no taxes. I'll show you how to do all that. Click the link below. It's completely free, no strings attached. You don't have to do anything, just show up. I'll do the rest.
Your future is at your fingertips. Take advantage of the flexibility and diversity of futures trading with NinjaTrader, the #1 rated futures broker.
What's going on, guys? It's Henry, back with another video. And in this video, I'm going to be talking about small account strategies. I know so many people out there are trying to grow their small portfolios. And today I'm going to be talking about some strategies that can turn $70 into $430 or even $700 into $4,300. So yes, I'm going to basically talk about how to 6x your money with a small portfolio. I'm going to be discussing 3 different strategies that I want to share with you today, and I think you're going to really like what I have for you. Also, make sure to check out the free email newsletter that I have in the description. I usually give free weekly value over there, and it also doesn't hurt to hit that like button and subscribe. Now, something important I'm going to discuss is closing positions, because a lot of students have asked me about closing positions, when to do it. So we're also going to discuss setting stop losses. It's very important to risk management. It's also very important if you want to be a profitable trader. So people think that you need a large portfolio to make a lot of money, and I I want to debunk that myth because it's actually just not true. You can actually turn a smaller portfolio into a medium and a larger portfolio. It just takes skill, knowledge, taking proper risk, managing your losses, and of course, risk management. And the combination of these things will allow you to grow a small portfolio because it's not like you have to have a 7-figure portfolio like me to see some good returns. I'm going to be showing you a few different trades on 3 different stocks that I think is a very good trade. And in fact, I would place that trade if the market weren't closed right now. But as soon as the market opens up, I'm actually going to be making these plays. All right, so the first thing that I want to show you guys is I'm going to open up AAL. And the reason why I want to open up American Airlines is because the strategies that I'm going to be using today, well, one of the assumptions is that the stocks are not going to tremendously shoot up or fall. Basically, our assumption is that a stock is going to continue to go sideways. In fact, all 3 strategies that I have today is going to consider that a stock is going to go sideways because part of that reason is I think the market is high, but I also don't see any catalyst for it to fall any lower. So I think the market will trend sideways. But anyways, you can pick your own stocks. This is just me showing you what I'm going to be doing and my thought process. You don't have to copy this. By no means am I a financial advisor. Just go ahead and learn everything that you can and then apply this knowledge to your own stocks and your own watch list. So taking a look at American Airlines, it has had some volatility. However, what I've noticed is as soon as it jumps up, it always tends to fall back down. In fact, if I go to 6-month chart, it pretty much hasn't gone anywhere in the past 6 months. I mean, sure, it did start off around $25, but if you take a look right over here, I'm going to scroll down right now, around July 19th, this stock is still trading where it's been on July 19th. So for the past 4 months, this stock has gone up, down, up, down. It's pretty much traded sideways, gone up, and then back down, up, and then back down. And I kind of understand that this pattern is going to continue with American Airlines. I don't see any reason that it's going to fall too much lower. I don't see any reason why it's going to jump back up in the next couple of days. So for this week, I'm going to show you a strategy that is basically going to turn about $70 into $430. I'm going to open up that position in Robinhood. But real quick, as you guys can see, every time it jumps back up, it trends down, and then it'll go sideways for pretty much a week. So this is about a week. This is about a couple week period right here. This is from the 16th, and this is going back to the 16th. So this is an entire month where American Airlines has traded sideways. Essentially, that is a thesis for American Airlines. That's where I'm going to be starting here. I'm going to go to Trade American Airlines Options, AAL Options. Now, you can pick any date that you really want. I typically like to go for weekly options or bi-weekly options. The reason why I like to go for weekly options is because not a whole lot of stuff can happen in a given week. I mean, unless there's an event like maybe earnings or there's a Fed meeting, then there's usually not a whole lot of events that can turn an option upside down. And if the option doesn't go in my favor, I can always set a stop loss. I can always close the position. And it's much easier to monitor a position in a given week than have a option that is out for a month or 3 months. That longer term time period is just harder to trade because it's easier to bet on a stock going sideways in a given week than for a stock to go sideways in a whole month or a whole 3-month period. So now I'm going to look at the option chain. And again, as an option trader, my assumption here is that the stock will move sideways. So the first thing that I'm going to do is I'm going to sell a call option that is near the money. So right now, American Airlines is $19.53. I'm going to sell the 19.5 strike. And that's basically at the money. It's only 3 cents off. So I'm going to click right here. It's going to be worth $30. And I'm going to click sell. This is going to be $30. And now what I'm going to do, this is very important. I'm going to go buy a call option. You guys will see I'm going to enter a custom order. So this option strategy is going to be a custom order. And you're going to see on the right side, right over here, the exact payoff, the risk that I'm taking, and the profit that I'm going after. Okay, so going for buy call option, I'm going to buy a leg above and a leg below. This is going to be important when you guys see this strategy actually play out. Getting started here, 19 strike. This is the leg below the 19.5 that we have open. So I'm going to open up this call option right here. This is going to be a buy. Now I'm also going to buy the 20 call option right here. Now, if you notice, the cost is 42, but what I'm going to do is right here where you see this custom order, there's a little drop down menu here. I'm going to go to custom. Rather than a 1-to-1 ratio, I actually don't want to open up 1-1-1. I'm actually going to go ahead and sell 2 19.5s. Going to the custom, clicking right here, going right here where it says 19.5, the option that I have sold. I basically want 2 of these sell orders to account for this 1 and 1 buy order. All right, cool. Now that we have entered answered that, I'm going to scroll down and you guys can see that this is a very beautiful chart and I'm going to explain it right now. The max loss right here is $12. However, your max profit is $38. So as you guys can see, in this example right here, you can triple your money. You can actually bet $12. That is your total max loss. You can't lose any more than that. And the total max profit is $38. Now, again, the assumption here is that American Airlines stays right around the center point where it's currently at right now. So at this point right here in the middle is going to be a max profit of $38. And you're only going to start to lose money if American Airlines goes past $19.88 or if it goes below this point right here, which is $19.12. So as long as American Airlines stays within this range, which again is considering that the stock is going to move sideways, you're going to be able to collect that full $38 at this very peak, and you're going to collect the different varying amounts right here. But obviously it's still very easy to double your money even at this point right here or this point. As long as you stay within this green area, you're going to see a profit. Around this area, you're going to see a double, and at the very peak, you're going to see a triple on your money. Now, this is a strategy that is fantastic for growing a small portfolio on a stock that isn't going to move very much. I probably wouldn't do this strategy on something like a Tesla where the stock is moving tremendously up and down. I would do this on a stock that is not moving very much because you're going to have a much better chance at making a profit. So I also like this a lot because what I teach my students is basically weekly income strategies where we're collecting 1 to maybe 5% on the higher end per week. This is a good strategy for some of the people that want to aggressively grow their portfolios. Maybe 1 to 5% a week isn't enough for them, so they want to go for something that is maybe riskier or has greater leverage. This is a strategy where you can actually double and triple your money. So some of the people with smaller accounts are going to want to incorporate this strategy into their toolkit. All right, guys. So real quick, what I want to show you is this other trade on American Airlines that I found that can turn $1 into a maximum profit of $49. So basically, you can 49x your money or basically 50x your money going from $100 to $5,000 on this single trade right here. And the reason why I want to show it to you was because I forget where I was looking at that trade from $700 to $4,300. I don't remember what I was looking at, but I found a better opportunity that I want to share with you. Now, what I did here was the very exact same trade, except I went for December 3rd. Again, I went for the same trade that I just showed you guys, but I bought the 18.5 call, I bought the 19.5 call, and I sold 2 19 call options. Now, the total cost for this trade is $1. You can get started with just $1 here on this trade, and essentially, as long as American Airlines stays within this range from $18.50 up to $19.48, or right around where it's at right now, or right around the current price, then you're going to make somewhere up to $49 depending on where the stock actually ends up trading. And again, the maximum amount you can lose here is $1. So there's very little risk here and a very huge reward on this trade. Now, the next stock I want to talk about is Palantir Technologies. This is a stock that when you look at the chart, it has been going sideways for a very long time. And recently it has fallen down quite a bit. Now, regardless of the reason why it has fallen down, usually this stock will move up or down, very similar to American Airlines, which is why I picked this stock as a second strategy that I want to show you guys. Because once the stock goes up, it'll come down, it'll consolidate, it goes up again, goes down, consolidate, goes up, goes down, and consolidates. So this is basically the perfect time where I see another strategy that an investor or an option trader can play for a stock moving sideways, really benefiting and cashing in on a stock not doing too much in the near future. So in a given week, I can see Palantir continuing to move sideways because the pattern right here is moving up, down, sideways, up, down, sideways, and then again, up, down, and now I expect the stock to go sideways. Because once investors come into a stock and then they crash the stock by taking a lot of profit, at that point, if there's no catalyst, there's no reason for the stock to move up or down again. So usually it trends sideways before there's another big catalyst or some news event or earnings or some announcement that is going to move the stock. So for this given week or even the next couple of weeks, I expect the stock to move sideways because from this period of July 13th to about August 13th, it was basically a whole month where the stock just moved sideways. I mean, it's not a full month, but it's about 28 or so days. From this period of October 4th to about October 15th, again, a 2-week period. Sure, the stock moved up, but it actually just moved up from $23 to $24. So that is basically a sideways move. And now since the stock is around $21.41, I'm going to come into my Robinhood platform right here. Again, I'm going to go trade PLTR options. Now, this strategy is going to be somewhat similar, but I'm going to show you guys the slight difference and exactly how much money you can make here trading Palantir options in a given week using another sideways option strategy, which requires almost no money. I mean, I'm going to show you guys how much money it's going to require. transpires. First of all, I'm going to go sell a call option. Now this is going to be very similar because I'm going to sell an at the money call option, selling this one right here to 21.5. And again, I'm going to do the same thing that I did before, and you guys will see the difference in just a second. I'm going to go buy call option. Okay. Now I'm going to move for the leg lower, right under 21.5. Okay. So this is the current leg that I have open, 21.5. And now I'm going to buy the leg under the 21. Okay. So I'm going to click here, bought this for $75. And now I'm actually going to go back to the 21.5 and buy the leg above it. So the leg at the 22 strike price. Now I'm going to click buy right here, and that is going to complete this trade. However, now I just have to adjust the custom order. So again, I'm going to click this little drop down menu right here. I'm going to go to custom order. And now for the option that I sold, I'm actually going to go right here and enter 3. So rather than going for 2, I'm going to enter 3. That makes this payoff a little bit wonky, but what I'm going to do now is I'm actually going to sell 2 of the highest strike call options. So rather than having 1, I'm going to click 2 right here. And now you guys will see right here that as long as this option stays within the certain range, that you're still going to have a massive benefit. Now here, this is another strategy that considers the stock moving sideways. However, now if the stock has a tremendous rise, then you are going to lose some money. However, again, taking a look, the max loss is $39, but the maximum profit is $61. So you can almost double your money in this trade. And again, the reason why I'm going for this type of trade on Palantir is we go back to the chart right now. This stock has had a tremendous pullback, and now it continues to fall. So we've had one big pullback where we had a major sell-off. We had a little bit of a bounce back. However, that bounce back was not sustained, and now the stock is continuing to fall. And then it had another small red day. Actually, if I go to the 1-month chart instead here, it's going to be easier to see. This stock has now gone down on a one single trading day of basically 9 cents. So I can see the stock continuing to fall down just a little bit. But again, have your own assumptions. Don't just copy what I'm telling you right now. Go pick a stock, have your own assumptions. And if your assumptions fit this description, then go ahead and run this type of strategy where you expect the stock to potentially slightly pull back, but basically you expect it to trend sideways and stay within a certain range. This strategy is going to be phenomenal. Now, it doesn't have as much return as the strategy that we just had before. However, again, turning $39 into $61 is going to be greater than a 50% return, or right around that 50% return mark in a single week. So obviously someone can put up $3,900 and turn it into $6,100 if the stock were to end around $21.50. All right, so the third strategy and what I want to show you is going to involve NIO stock. So if I pull up the NIO chart right now on my screen, we know that NIO is a stock that I've been following for a very long time, and this stock has frustrated investors. However, it has honestly not really frustrated me. As someone who's just a stock investor hoping that NIO is going to go to the moon, it has been a very difficult journey. However, for option traders who are selling put options, who are selling covered calls, and who are just running different option strategies that I teach my students, we have basically had a blast with the stock, because even though it has gone nowhere except for basically up, down, up, down, up, down, that's actually a fantastic thing for option traders, because option traders love volatility, and also option traders can take advantage of a stock not going anywhere and still make a ton of money, whereas stockholders cannot really do that. So now taking a look, NIO is currently sitting right around the moving average that it has been at for the past 60 days. Yes, the stock has been lower, the stock has been higher. However, it's currently at the moving average, and I expect the stock to continue moving sideways until we see some really good numbers or some good deliveries, and that's not going to happen until early December. We're not going to know how many deliveries NIO had in November until December hits. So for this week, as an example, or if you're watching this in the future, if there's no catalyst, there's no earnings, or there's no deliveries for an EV company, then again, you can run a strategy that benefits from a stock going nowhere or really going sideways. So what I'm going to do right now is I'm going to trade NIO options, very similar to what I've been doing. Now I'm going to start off with selling put. Again, I'm going to have the expiration date for November 26th. Pick your expiration date that you want to go for. Again, I recommend going for weekly. You can go for bi-weekly. Whatever date you're watching in the future, pick the expiration date that works best for you. Now, what I'm going to do is I'm going to sell a put option at the closest to the money, but slightly under than the current share price. So right now, NIO is currently trading at $40.24. I'm going to sell the 40 strike. Now I'm going to cover this up by buying the next leg lower. So I'm going to buy the 39 strike right now. now. And there we go. We have opened up a put credit spread. However, now what I'm going to do is I'm going to continue opening up 2 more legs. Now, the only thing I did right here on the top is I'm going to sell a call option. The call option that I'm going to sell is going to be nearest to the money, however, a little bit out of the money. So rather than going down to 40, selling the 40 and buying the 39, now I'm going to sell the 41 and I'm going to buy the 42. This is going to open up a short iron condor position. You can actually see here, unlike the other 2 strategies where we had to spend just a little bit of money and we could have turned a small sum into, 50% gain or a double or a triple on your money, here you're actually going to collect a credit. You're actually going to get paid. If I scroll down on the chart right here, again, you can see right here that the stock has to trade within a certain range. So as long as NIO stays within $39.18 and $41.82, you are going to collect a profit in this area. Now, your max loss is $18 and your max profit is $82. So in this scenario, you can basically 4x or even a little bit more than 4x your money on this single trade as long as NIO stays around this top area right here. So for me, this is one of my favorite strategies. This is what I teach a lot of my students because I love collecting a credit to begin with rather than paying money up front. I'd rather collect some money coming in. This strategy is a little bit more advanced. However, you can turn $180 into $820. If you enjoy strategies like this, or if you want to follow my trades and see how I'm trading live every single week, then you can join the private Discord community. It also does come with a course on learning exactly how to trade options. So if you want to learn a real skill that makes money and get results, then I'd recommend you submit an application to work with myself and my team. And make sure to check out more of my option trading videos. Here's a student in my private Discord that took the play. I'm going to show you shortly. It made 200% on his money. Another student messaged me in a play he opened with $11,000 reward for less than $4,000 worth of risk. So basically, I'm going to be talking about how to 2x to 3x your money with a small portfolio fast. If you can do this even a few times a year with your risky portion of your portfolio, then it will drive your returns much higher. But obviously, we will also talk about managing these small option trading strategies so you don't lose your money and understand how to enter and exit these trades. Closing these trades is very important. It can be the difference between being profitable as an option trader or losing some of your capital. Because smaller strategies do tend to have greater risk, you need to understand how to get in for the cheapest price possible, manage the position, and then close it with a profit on your hands. You're really going to like what I have for you, so make sure that you take notes. Each of these strategies will aggressively grow your portfolio more than the basic strategies, but these strategies also require more time and work to manage the position. That's because more volatile strategies, especially buying strategies, I do like to close earlier than expiration, as you will see. Make sure you also get your free copy of my Ultimate Option Trading Basic Guide by signing up to the free email list below. I do also have a paid Discord with 6- and 7-figure option coaches, a course, buy and sell signals, portfolio access, and every single trade that I make.
In every heartbeat lies a purpose. With each hammer strike, a badge of honor. Craftsmanship that stands the test of time. Because what we build isn't just in front of us, but what we leave behind. From today's labor to tomorrow's legacy, craft your future with Timberland Pro.
And making in One Academy. Cost varies based on your goals, so I'd love you to just check it out. Book a free call, no obligation unless it's a perfect fit for your needs. Fair enough? It's the first link in the description. All right, so people think you need millions of dollars or something to make a lot of money, but I want to debunk that myth. With the first small account strategy that you're going to see, you can have insane results, but I'll discuss what you need to get correct to get the maximum gain, which can be anywhere from 2 to even 50x returns. I just want to say though, this position requires attention. I understand people want easy and fast money, but money isn't easy. It's either very difficult in terms of time and managing, like this first example I will show you when I jump into my screen, or it's expensive because you get a shortcut like going to college, mentorship, or taking a course. But I'll do my very best to walk you from A to Z in this following example. Here's an image of the first trade. It's showing a profit of $1,493, but has no risk. risk. This isn't fully true because Robinhood isn't accounting for the costs of filling this trade, which I will discuss shortly. The cost is really going to be a few $100, but the gain is many times more. The position is created with 4 options consisting of 2 call options and 2 put options. These calls and puts are spread out over 3 different strike prices, all with the same expiration. The goal is to profit from conditions where the price remains fairly stable and the option demonstrates declining implied and historical volatility. Let's jump into my screen and I will open this trade for you to see step by step. All right, now let's take a look at this Tesla Christmas tree. Now that I have opened up my account, I'm up currently $261,000 on Tesla, but I want to show you the small account strategy using Tesla. Now, what we're going to do, we're going to go to Tesla options. So that's the first step. Now, the first step to opening up this position is to sell a call option. Now, I'm going to pick a date somewhere in the future. If you're watching this in the future, it doesn't really matter because this strategy is going to work the same whether you're watching this in 2022, 2023, or beyond. Okay, so I'm going to pick an option that's about 1 month from expiration. Roughly 4 to 6 weeks is fine because when a stock consolidates, it typically moves sideways for about 3 to 8 weeks, somewhere in that range. So 4 to 6 weeks is going to be a good time period for me to bet that Tesla isn't going to have a whole lot of movement. Again, this is Tesla, so it is harder to predict because Tesla is a really volatile stock. But again, you can choose this strategy on a stock that you think is consolidating. You can use technical indicators like RSI, moving average, or one of my favorites is Bollinger Bands. So I'm going to click May 6 right now. And for May 6, I'm going to sell the $1,100 call option. So step number 1, sell a call option. Now, this call option that I'm selling is going to be the peak of my Christmas tree. It's going to be the very peak. And if Tesla stops right around $1,100, that is where I'm going to see the biggest gains on this position. But again, I don't have to have this option expire. What I can actually do is as my option approaches expiration, say it's the end of April or even the beginning of May. Now, the beginning of May would be really close to this option's expiration, but let's just say a couple weeks has passed and the stock is trading for around $1,100. That's when this option is going to see a lot of gains, even though it's not even that close to expiration. So step number 1 is you want to sell a call option. And again, this is going to be the peak of your Christmas tree. Now I'm going to buy a call option. Now I'm going to buy a call option at 1080. That's because I think Tesla will stay above 1080 for the next couple of weeks. And now what I can also do is I'm also going to protect this position by buying an 1120. Now you will see how this is going to end up playing out when I go over here and create a custom order. But first of all, pick a sell. We pick the sell. Now we're buying a call option under the strike price, so 1080. And now I'm going to buy a call option over the strike price at 1120. So now I have completed this order. The only thing that I need to do now is I need to go into this custom order section. This is going to be really important because basically you need an equal amount of buys for each sell. So you don't want a 1-to-1 ratio. You want to click custom right here. And because we have 1 buy and a second buy, but we only have 1 sell, this is not a balanced trade. And as you can see, it's going to be costing you a lot of money. Well, I can imagine that many people do not want to pay $8,000 to open up a position. So instead, if you end up selling 2 of these, the actual cost of this position is going to go down to just $52. So this is going to change by the minute. However, as you will notice, about 33 to 50 bucks and our total profit is $2,000. So this is an extremely powerful strategy because you're only risking a little bit of money for a very, very huge gain. In fact, right now, as it currently sits, it's $13 into $2,000. It's pretty insane. But of course, if you do go fill this, I do want to say one of the issues is because you're dealing with 4 different options right now, this is going to be a little bit more expensive than $15. I would imagine this is going to be about a $50 to $100 spread. And now as I'm talking here, it has actually set the max loss as 0. But again, I think this is going to be about $50 to $100 if you're going to open up this trade. So it's going to be about a 200x opportunity. So right now it's currently trading for about $100. So again, 200x opportunity is what you can get with this position. Now let's talk about managing this position. This is pretty much the most important thing. So this position currently expires on May 6th. The way you want to play this is basically if Tesla continues to trade within this range, you're going to continue to have profit because you're paying very little money. So even if Tesla is going to be right here around $1,080, you're going to see a decent profit. If Tesla goes beyond $1,100 up to $1,100, $510, you're still going to see a profit. As long as Tesla stays within this range right here, in the next few days, the next few weeks, you're going to see a lot of profit, and this position is going to move to a few $100s worth of profit. Now, you're not going to see a full 200x gain until you get closer into the May expiration. At that point, you can close this option for a potential $1,000 gain or higher if Tesla is still within this range, especially if Tesla is hovering right around $1,100 in this example. However, all you really need to happen is for Tesla to stay within this range. So the most important thing on running this strategy, whether you're doing it on Tesla or any other stock, is to have a stock stay range bound. Now, the way I would close this trade is I would set an expectation for, hey, I'm putting up $100. I want to leave this trade with $1,000. So that's probably what I would do. However, I would probably sell this stock at a $500 gain as well. So if I see that the position is up $500 or $600, then I have 5 to 6x my money. At that point, I typically like to sell and take a profit because the saying goes, you never go broke taking a profit. Now, for a lot of people, it's really going to depend on how aggressive you are. If your thesis continues to stay that I think this stock is going to trade within a certain range and it continues to stay right around the peak of this strategy, then you can keep holding that position and keep gaining more money. However, if you feel there's a lot of volatility in the stock, you have a big profit in your hands, and you're scared to lose that profit, I would just say, don't get greedy. Take a 5 or 6x return. You have seen how to place the trade, but there's also a lot more factors you need to know to make money from this trade. The trade profits as expiration day approaches if the price lands within a range near the center strike price. The most important thing is you pick and forecast a target price you believe the stock will land on at some point in the trade. Because I don't hold this position until expiration, it's only important the stock approaches the top of the profit chart at some point in the future, but doesn't have to end there. That's because when I open this trade, my goal is to close the trade when the stock moves toward the strike that I sell. In the example, we sold the 1100 strike. So basically the stock really has to do nothing for a few days and the position will see a nice profit. Even if the stock moves up a bit, then down, that's still fine as the position will see daily profits if the stock stays within a tight range. So this first strategy is really for when you see a stock consolidating and not having much movement. This typically happens after earnings has come in and there isn't much more news expected on the stock. I like using this strategy on blue chip stocks that have predictable charts. One of these stocks, which is super cheap, is AAL or American Airlines. Let me show you a quick example so you can see this very cheap option trading strategy in action. All right, so the next stock that I want to talk about is American Airlines because this stock, if you look at the chart, it has been a pretty steady stock. So over the past 3 months, it's basically up 0.86%. It has done absolutely nothing for 3 months. If I look at the 1 year, it has gone down about 21%. However, typically within a 3-month time period, this stock really doesn't do too much. So if you take a look, it's been $22 on June 22nd. And now if I go to about November, which is 5 to 6 months, this stock is still at $22. So it didn't do anything for 5.
Sid's been thinking about getting dentures for a while. Maybe now's the time. Aspen Dental offers a full suite of denture products to get you exactly what you want, all while fitting your budget. Plus a guarantee. They'll make it right or your money back. It's one more way. Aspen Dental is in your corner.
5 months. Now, again, if we take a look from about late November, it's been about $19 and currently it's sitting about $18. So this stock really doesn't have a whole lot of movement. It seems that investors are trading American Airlines in a very tight, narrow range. So at any given 1 month or 2 month period, this stock doesn't really do too much, which is a fantastic candidate for the same strategy that I was just showing you. However, there are a few key differences with American Airlines. Now, the main key difference is that American Airlines is an $18 stock and not a $1,000 stock. That is actually an advantage in some regards and also a disadvantage in other regards. Let me go over an example. So again, I'm going to go for an option that's going to expire on May 6th because it's about 5 weeks away. And I just mentioned a stock like American Airlines isn't having that much movement in a single month. So the first thing that I'm going to do, again, is I'm going to sell a call option. I like to go for at at-the-money call options. So right now I'm going to sell the $18 strike price. It is just slightly in the money with American Airlines trading at $18.08. Now, what I'm going to do is I'm going to buy the $17 call option, and now I'm also going to buy the $19 call option. So now you'll notice again that I have a total cost that is pretty significant. It's $145, which is kind of a lot for a very cheap stock. So what I'm doing now is I'm going to go to contract ratios. So whether you're doing this on Robinhood or a different brokerage, I do recommend Robinhood. They do give you some free stocks. I'm going to put that in the description, but it doesn't matter which brokerage that you use. It really doesn't, as long as you're following what I'm doing step by step in your brokerage. So click custom order or make a custom order where you're selling the equal amount of shares that you are buying or the equal amount of contracts. So I'm going to sell two $18 contracts. Now the total cost is only $14. If I scroll down right here, we can turn about $15 into $100, which is basically an $85 profit. This is over a 6x return. This 6x return can happen by May 6th or by about 1 month from when you're watching this video and you open up a trade just like this. However, again, I want to caution you that you're usually not going to see the full 6x because there's a few factors at play. One of the factors is there's bid and ask spread costs that you have to account for. And the second thing is that typically this stock is not going to end right at the very top, right at $18 in this example. You're typically going to have the stock end somewhere between this range, but also you're typically, or you actually should, close the position before expiration, because as expiration approaches, this option position becomes very volatile. However, as long as the stock stays within this range and a few days pass, a couple of weeks pass, this maximum loss of $15 will start to go up, because these options will start having a very high probability that they will end somewhere in the zone. And because they're going to end somewhere in the zone, you are going to start seeing a profit. So you might turn $15 into $30 or $45. So you may get a 2 or 3x gain. And at that point, I would look into selling this position for a profit and getting rid of it early, because with this type of strategy, you really want to manage it. You want to keep your eyes on the profits. And if you see a 2 to 5x profit, you really want to get out of the trade before it can go south on you. All right, so now we're going to go back to Tesla. I want to show you a slight variation of the strategy and how you can actually bet on the stock doing something very specific. If you get that right, you can again see a 5 to 200x on your money. So right here, as you see, as I'm even making this video, Tesla is moving closer to $1,100 per share. So if I actually opened up that first position that I was showing you guys, I would already have a gain on my hands of about 10% because the stock is moving up towards the price that I believe it's going to be around. But what I want to show you specifically is, say as an investor, you actually believe that Tesla is going to go up to $1,200 per share, or you have a very specific view on a certain stock. Well, what you can do is you don't have to sell a call option right at the money. You can actually sell a call option for the exact price that you think the stock will end at. So let's say that we believe that Tesla is going to end at $1,200 per share. That is going to happen by May 6th. Or actually, let's say that it's going to happen at next earnings, and let's say next earnings are sometime in June. So let's say that June 17th will capture earnings. So now what we're going to do is we're going to pick June 17th. Now we're going to again go to sell call option and say that you think the stock is going to end at $1,200. What you're going to do now is you're actually going to sell the $1,200 call option, because that is going to be the top of your profit chart. So selling the $1,200, I'm going to go a little faster. I'm going to buy the $1,150, and now I'm going to sell two strike prices above as well, the $1,250. And again, one important thing is I need to go right here into the contract ratio, click custom, and I'm going to sell two call options to match each of the call options that I'm buying. This strategy now costs $295. However, it can bring in a total of $5,000 worth of profit, or about $4,700 after you account for the money that you're paying. So now the top of this strategy is actually going to end when Tesla is $1,200 per share. So if your target price is $1,200, you don't have to bet at the current level. You can actually set up the strategy for anywhere that you wish. And the way that you control this is by picking the strike price and selling the strike price that you believe the stock will end at on expiration or sometime in the near future. So basically right here, I sold $1,200. Again, over the next few weeks, if Tesla goes up towards this price and it goes up right here, that's actually going to be a very big profit. It currently says $1,000, but if this happens in a short amount of time, then this position can be up actually $2,000 or $3,000, and you don't even have to get into June 17th or wait for the option to expire. You can always close this option for a profit as long as the stock is moving in the direction of the peak of your strategy strike price. Remember, these are riskier trades you need to close before expiration when you see some profits. Don't get greedy on these trades because profit is profit. If you need help or want mentorship, the first link in the description is a way to work with me.
When it comes to paying off debt, you can save time and money. A debt management plan from the 60-year national nonprofit GreenPath Financial Wellness is designed to pay off your debt in 3 to 5 years and may result in lower interest rates and lower monthly payments. How much can a debt management plan save you? Find out by calling GreenPath today.
Welcome to the free course on option trading. In this video, I'm going to spend some time going over many different concepts about option trading and take you from a beginner to an intermediate option trader that can make $10,000 or more per month. In this full course, I'm actually going to be not only teaching you, but going step by step through the journey that I had and giving you the blueprint to having a similar journey to make multiple millions of dollars. Just like my portfolio on screen, I have a $1.8 million portfolio. And although this year wasn't that good at just 25%, I've had previous years that were at 50% and even 700% when I was growing a smaller portfolio. It is much easier to grow a small portfolio than a big portfolio, and I do have the blueprint for growing a small, medium, and big portfolio. So we're going to talk about all three of those, as well as strategies. I'm going to go over call options, put options, the wheel strategy, the poor man's covered call, selling puts, buying puts, spreads, credit spreads, debit spreads. I'm going to be giving you all the secrets to managing different strategies. So I do have some notes in front of me. We are going to spend some time going over some ETFs that I personally like, some stocks that I would personally pick for using options. Those stocks will include Tesla, Palantir, SoFi, Apple, Amazon, Microsoft, Google, and many, many more. I'll be using Robinhood personally. I do have a couple of brokerage accounts, and brokerage accounts don't matter. I'm just giving you the tools, the education, and the knowledge to actually make money and do this for yourself. And hopefully make this a full-time career like I have, so you can travel the world, have more freedom, and live the life that you deserve without having a 9-to-5 or a boss. So let's first of all talk about small accounts. I am not personally biased to a small account, a medium, or a large account. Everyone has to start somewhere. I personally started with $2,000, and when I was going to Drexel University, and I also had some time at University of Pennsylvania, when I was going to college, I had some internships. The internship that I had first was working on Wall Street on the New York Stock Exchange. This was for a hedge fund that was trading options. I was sitting there next to other option traders. There was 4 option traders, and they were making between negative $5,000. Some, the bad ones were losing money, and other ones were making upwards of $50,000 per day. So I got to see what a good option trader looks like, what a bad one looks like, what the market does, what brokers do, and I got to learn a lot about the inside secrets of Wall Street. That was just one of my careers. So look, the secret to growing a small account is starting small. It's really hard to diversify a small account. So therefore, you will have to use more buying strategies. When you don't have a lot of money, you're going to want to use call options. A call option is a position that lets you benefit when a stock goes up. That's all it is. It's a bet that the stock will rise. A call option makes money as the stock goes up. So let me show you an example right now. If I were to buy a call option, let's say that I think Apple will go up. Apple is really a good bet because Apple is such a huge company with a great brand. So I'm going to go trade Apple options. Now, if I'm going to go buy a call option, you will see that I do have to spend some money. So for example, here, if I buy a call option at 197.5, I have to spend about $105 or $105. This is amazing because I get to spend a very little amount of money and I get to benefit as if I had 100 shares, but I don't. I don't have to buy 100 shares when I buy a call option. Now, buying a call option is not something that I personally do on a day-to-day basis. It is one of the best beginner strategies, and it's phenomenal for making a lot of money. However, as you will learn in this free course, my method of making money is more safe passive and consistent. And there is nothing consistent about a buying strategy. That's because you're making a bet for something to happen. Instead, in my personal philosophy, and after working at Goldman Sachs, what I have learned is that selling options is much more favorable than buying options. That doesn't mean that you shouldn't buy options. Again, if you have a smaller portfolio, you basically have to buy options. However, there are better ways to buying options than just buying a call option. But let me quickly show you what buying a call option looks like. When you put up money to buy a call option, you are betting on it rising. Now, you needed to go to the strike price of 197.5 because that's the strike price that you're buying. However, you've also paid about $1. That's why your actual break even is going to be $198.54. So you actually need the stock to rise by a little bit more than the strike price. However, to break even, you only need the stock to go up by 1.43%. So in 5 days, if Apple goes up by, say 2%, you're actually going to make pretty good money. If Apple were to go up by $5, then you would make $200. That would be the price of the stock minus your break even of $198.54. So the difference there would be about $1.46. And because we're buying this at $1.05, you would actually more than double your money even if Apple only moved up a couple percentage points. That is the power of options. You can literally double your money in a very short amount of time. In just 5 days, you can make 2x on your money. In fact, you can even make 10x on your money in a month or 2 weeks. It just depends on how much the stock moves. And that's the beautiful thing about options. You can put up very little amounts of money and get very big returns. Now, this is what most people do, and it ends up being okay for some time, but also it could potentially blow up your account. So you need to be very wise when you're buying options and use proper risk management. Now, most people don't teach what risk management is. Most YouTube videos, in fact, YouTubers don't even know what they're talking about. They just sound like they know what they're talking about, but they don't actually have experience like I do or a degree to back up their claims. So let me tell you, the most important thing is risk management. You can be right about a stock. You can make, in fact, you can go from $2,000 to $20,000 to $200,000 to $2 million. And if you're not using risk management, you can take that $2 million and lose all of it and go way back down to zero.
Are you trading S&P or NASDAQ ETFs? Discover futures from CME Group on the equity indices you know and love. With around-the-clock liquidity and lower margin requirements, enjoy the benefits unique to futures. Start trading today.
Want gloriously scented skin? With Soap & Glory's cult classic fragrance, skin feels silky soft and smells glorious. Soap & Glory. Just like that, you're glorious. Explore the range.
Which would emotionally crush you, and it would be really devastating. So you need to understand that you always want to have no more than 10% of your money in any single position. However, if you think about it, I personally have more than 10% of my money in certain positions. For me, I have a lot in Apple, and that's because when I believe in something and I believe that that stock, that company is going to be, a long-term play, then I will invest my time, my energy to be in that company beyond the 10%. And for me, Apple, Amazon, all these good positive companies like the tech companies, big blue chip companies that have a good brand, these companies are okay to break rules. But for option trading, if you're just going to buy a call option, it's even better to go to 5% per position. So if you have $2,000, then 5% would be a $100 bet. That way, if the option doesn't go in your favor, you will lose just $100, but you're not going to lose your entire portfolio. And that's where most people go wrong, is they invest way too much. Now, what is the better strategy to just buying call options? Well, that is going to be a poor man's covered call. We are starting off again with small portfolios. And as we continue this course, we're going to talk about medium portfolios and large portfolios. And let me tell you, if you are starting with a small portfolio, I love that you are devoted to this journey. And it does take time. You are going to have to take some time to grow your portfolio. And it is a function of two things. I've always said on this channel many times, I'm very transparent. I show everything. In fact, if I go to my account, you can see right now that, I can even show you my history. I can go to my history. I can show you my tax returns. I've done that many, many times. That's because I'm not looking to hide anything. I just want to transparently show you what I am personally doing, what's worked for me, and I'm doing this because it's my passion. So if we look at some of my history, We can obviously go on for a very, very long time. But when you have a small portfolio, it is really important to manage your money the same way as it's $2 million. So when you have $2,000, you really have to focus on it. But also, let me tell you, that you also need to add money to your portfolio. Growing your wealth, I did not grow $2,000 into basically $2 million without adding any money. I have added some money. The majority of my wealth here in this portfolio was built through returns, but I did add about $400,000. So I'm just being transparent and honest that I have added money as I was making money in my internships. Now I wasn't making a lot of money, and I added most of that $400,000 just very, very recently as I became a coach and a YouTuber. You need to understand that you need two things. You need to keep adding money to your portfolio, and I don't care. It could be $500 a month. It could be $200 a month. You want to set up a consistent plan, and then you want to use consistent strategies. So again, we talked about buy and call options. Let's talk about a poor man's covered call. A poor man's covered call is amazing. Let's just say that we want to invest in Adobe stock. Let's just say that we want to invest in Chipotle stock. Chipotle is an expensive company. And if you were to buy 100 shares, that would be over $200,000. Basically, it's like buying a Lamborghini. Now, I know most people don't just have $200,000 laying around. Heck, I don't even think I have that laying around in cash. So what you can do instead is you can invest in any company using a lot less money. However, you can also make some money even buying options. So here's what it would look like. You would also buy a call option just like I just showed you. However, instead of just buying a call option and betting on it doing something in the short term, you would buy a longer term call option. This would be called a LEAP, a long dated option with a long-term expiration date. A LEAP is just an option that's expiring in 1 year. That's what textbook definition is. For me, it's just 6 months or greater. So let's take a look at, for example, January 17. This is about 1 year away. So that is good. Now, what I would do is, yes, this can be a fairly expensive strategy, but again, I'm just using Chipotle to show you how expensive Chipotle is if you were to buy 100 shares versus just doing a poor man's covered call, which granted, this would still be really expensive. I can show you another example, but let's just go over Chipotle just to show you how big of a difference it really is. So here, you can just buy a call option. So let's say I'm going to buy the 2100. That's going out 1 year. Already, you can see that, yes, it's a lot of money. It's $40,000. However, you would have to put up $220,000. So this is literally 1/5 of the price. Now, how a poor man's covered call works is you would sell a shorter term expiration. So let's just say I'm going to sell January 19, or roughly 1 month out. If you're watching this in the future, the logic is the same. This is a course that's meant to test time, and however many views it has, I expect this to continue getting views because I want it to be the best course. So please, if you will like this video, I would be so appreciative. If you subscribe, I promise I will make you a consistent option trader. Yeah, so now what we can do is we can go to sell, and for example, I can sell something that's really close to the money. So let's sell the 2300. Now you will see that I'm actually able to make about $2,300 or $3,000 in premium. So I'm collecting $3,000, but I can make a lot more. I can make more because this option can still increase in value. But the long story short here is that you can actually collect income on a call option. Now I get that this is a very expensive position, so let's just go to something a lot cheaper. So let's go to PayPal. So I'm going to show you an example on PayPal by also opening up a poor man's covered call. So again, a poor man's covered call would start out with a LEAP option. So I'm going to go out to, let's just say July 19, which is 222 days out, and I'm going to buy a 50 call. So of course, this is much more affordable. It's only $1,300. And now you can still sell something shorter term. So let's just say I sell something out into February, which is basically, this is a covered call. A poor man's covered call is very similar to a covered call, except you don't have to own 100 shares. That's what makes it so amazing. It's such a cheap strategy. So here you can see how I'm collecting $224. This position is great because now I'm only putting up about $883 in premium. I am collecting roughly $224. And sorry, I'm not actually sure why this max loss says 883. We're actually, in fact, putting up $1,146. And I know that because I've been doing this for 10 years. So I can see that this is some type of mistake. I'm not sure why Robinhood got this incorrect, but it is, in fact, incorrect because when you're putting up $1,370 and I'm collecting $224, this would be the difference that you have to put up. So a little bit over $1,000. And on a little over $1,000, you're basically collecting $200, which is like a 20% return. So I'm literally making a 20% return in a couple of months, and I can actually make a lot more. So if PayPal rises, you can see how the chart here shows that if PayPal rises towards the 65 strike, I can actually make $600. That's a 60% return in roughly 60 days or 1% per day. Absolutely insane. But of course, you do have to be right on direction. So with option trading, when I used to work for the first hedge fund, I was actually talking with a professional trader, and he was telling me that basically options are safer than stocks. And I was like, no way. No way. There's no way that options can be safer than stocks. But as I learned more about options, I realized that you are in full control. You can actually bet like a casino, like you're playing blackjack, and try to double and triple and quadruple your money very quickly and easily, but at the expense of really huge risk. Or you can also use options as a retirement strategy where you just make 1% a week, which is what I do. Make it super safe, make it super consistent. And yeah, it's not going to be very volatile. It's not going to make you overnight rich, but it's going to be really consistent and provide that passive income for you to actually leave your job and travel. That's why I've been to so many countries, is I have that time freedom, location freedom, and high income. So that all comes from option trading. And of course, having this YouTube channel has helped a lot. But originally, I became a millionaire through option trading. So with that being said, one of the biggest mistakes that you can make is really rush your journey. You can't rush your journey. For me, it took many years. It actually took almost 10 years to get to this point. I retired 2 years ago where I could have just traveled full time and didn't really have to work. I continued to work, continued to invest because I like it. I enjoy it. It's a passion. I don't know what else to do. So now I'm at the 10-year mark, and I'm well beyond retirement, where I can just go to a country and absolutely do nothing if I wish, besides sell options. Now, again, if you're working with a small portfolio, buying options is kind of crucial. But I will say that as we get on later in this course, you will see that I will give you the ultimate guide to spread trading. And now spread trading will actually give you all the insights and knowledge to basically use a very small account to make consistent income. Now, you're not going to retire on that, but you're going to make enough to pay some bills.
By the way, I'm paying for our pedicures. By the way, maybe next time.
People with the Wells Fargo Active Cash credit card prefer to pay because they earn unlimited 2% cash back on purchases. Visit wellsfargo.com/activecash. Terms apply.
Calling all pizza lovers. Enter the Cabot Saucy Pizza Sweeps for a chance to win a trip for two to your favorite U.S. pizza city. Visit Cabot Wine's Instagram for details. Imported by Palm Bay International, West Palm Beach, Florida. Campaign financed according to EU regulation number 2021-2115.
You're going to make enough to go out for dinners. And even if you have a few $1,000s, that's fantastic. Now, as you will also learn later on, as you scale your portfolio, you want to get away from spreads. And you want to just stick to the simple strategies of covered calls and selling puts, and the wheel strategy. And the wheel strategy is just covered calls and selling puts. You will know all about this very shortly. So what would I do and what would I avoid to actually get to the 7-figure mark? Wherever you are in your journey, do not rush and focus on high quality companies. So for me, I mentioned that we're going to talk about some ETFs. SPY is an ETF that basically has all of the holdings within it. It has 500 companies. Has all the best companies, has Johnson & Johnson, has ExxonMobil. In fact, we can take a look at SPY here because this is one of the best ETFs that you should really be invested in. You don't have to be a stock picker. You don't have to find the next trend. You don't have to watch CNBC. You don't have to really watch any news. And I'm not biased towards CNBC. I'm just saying you don't have to watch any news in general. You can just invest in some top quality companies. You use the simple strategies that I'm going to discuss, like the covered call, the sell put, poor man's covered call, and later on we'll talk about spreads. And that way you will grow your wealth and you can have it on autopilot mode. Many of my students are really, really excited the first 3 to 6 months until they realize how simple, easy, and automated option trading can be. Once you can set some positions, you don't actually have to do too much if you set them correctly. Now, let me just talk about the S&P 500. Okay, the S&P 500 is composed of many different sectors. Okay, one of them being technology, financial services, communications, consumer defensive, real estate, industrials, healthcare. Rather than having to become an expert and become a stock picker, you can just invest in the S&P 500 and you can get some really good returns. In fact, for some people, I would just say you can put all your money in the S&P. The main goal that I've always had is to make $300 to $500 per day. And I was never concerned with becoming a super fast millionaire or anything like that. Yes, I wanted to become a millionaire for a very long time, but I always focus on consistency because I'd rather make, in 1 month, 2,000, the next month, 2,100, 2,200, 2,300, and so on and so forth, than having 1 month that's $8,000 and the next month I lose $3,000. For me, it's really all about consistency, because if I can depend on that, then I can actually, have full freedom. Now, the covered call strategy is also fantastic, because let's say that you have 100 shares. Let's say that you're not even interested in option trading. Well, the covered call strategy is still going to be something that you want to use even if you're not an option trader. So many people that just hold stocks in their Roth IRA, their 401k, or just have some inheritance. Let's say that you inherited IBM stock. I used to work there. So if you have 500 shares of, let's say, IBM stock, so let's just go to IBM. I'll show you how you can actually make income with the covered call strategy. So you can still invest in really high quality companies and then use covered calls to basically generate income and get paid for stocks that you already hold. So that's what I really like about options is they make your stocks work harder for you. They make your stocks actually produce income. So here IBM's at 161. I'm actually surprised the stock went up quite a lot. It did pretty good actually in the past 1 year of just 10%. I guess that's not too crazy. So let's just say you have 100 shares here. So what you would do is you would do a covered call. So if you have 100 shares, you go to sell, call, and then you would just sell a call option that's way far into the future. That means you don't really have to do anything. You can just hang out, relax, and your stock will not only go up, but you'll also get the upfront cash of selling a covered call option. So, for example, if you have IBM, you can go ahead and sell the 170. So let's go sell, call, 170. Now, granted, this is not a lot of money, but it's $400 that's basically free. You collect $400 right now today as soon as you sell this covered call. And if IBM goes past 170, you will have to lose your stock. However, that's not that much of a problem because if you're okay losing IBM at 170, then it's not really that much of an issue. Then you're happy making a pretty good return of $8. The current price is 162 roughly. It's an $8 return plus another $4. So you would make $1,200 doing nothing for 131 days. That actually adds up to being about $10 a day or like $9.85 or something like that. Okay, so you can basically make $10 a day doing absolutely nothing with $16,000. Now, I don't know about you, but that's like 2 cups of coffee right there. Now, I want to talk about how to plan your wealth and how to actually grow your portfolio visually and financially. All right, guys, so in this part of the video right now, I want to show you what my net worth calculation sheet looks like and how I personally built my wealth and how you should plan. So check this out. If you're starting off with, let's just say $30,000. So you're starting off with $30,000 and let's just say you can make 35% returns per year, which is pretty high. I will admit it's pretty high, but definitely possible, especially with a smaller portfolio. As you can tell though, as you go far into the future, it does become harder to make 35% over and over again because, well, even Warren Buffett can't do that. Now, let's talk about the savings rate. So everyone in the Western world, because most people that I work with are from the United States, some Canadians, you should be able to at least put away $1,000 per month. So let's just put $12,000 because this is the yearly savings rate. Well, let's just focus on the first 10 years. Basically, if you have $30,000 and you can put away $1,000 per month and your return is 35%, then in 10 years, you will become a millionaire. And if you think about it, most people never become millionaires. They're just, on that rat race, on that wheel where they go to work, they get a raise, then their life expenses go up and inflation goes up and everything else goes up. So
This fall, it's all about dinner. So sweet. So sweet. It's genius. Only at Old Navy.
So even if you're making like 90,000 and then you make like 95,000, 100,000, 105,000, 115,000, it's like doesn't really matter because $115,000 in a major city is not really going that far, especially after taxes. So what used to be 6 figures now does not feel like 6 figures, and my new number for what 6 figures feel like 15 years ago is $250,000. So most people, unless you're a software engineer, doctor, business owner, which I work with plenty of those types of people, don't make that. So what you need to do is to make up that income to get to $250,000. Or of course, if you're going to travel like me, or if you go to a cheaper part of the country of the United States, then you can obviously get by with a lot less, especially if you own your own home. But check it out. I have a plan for you. In the next 10 years, if you're smart, you actually focus, you take action, and you commit yourself to option trading, and you don't look left and right, That's my right. This is my left. If you don't do that, then you will be on the right track to becoming a millionaire and financially free. If you look to the right and, oh, what's going on with Shopify, Amazon stores, and oh, this advertisement that I've seen talks about crypto investing and automated returns and this, that, and the third, okay? Don't trust that stuff. Just focus on your career, your active income, and then investing. Okay, if you do just those two things, you don't really need anything else. Yes, you can have a side hustle. Side hustles are good because look, if I add instead of 12,000, if I make it 15,000, you'll see that the difference is actually really, really big. So it's 1.25 million instead of 1,089,000. So it's over $100,000. This $3,000 per year makes a really huge difference. So as you can see, the way that finances work and how your wealth works is compound interest. And that's why the first 25 years of my life were just really difficult, where my parents didn't have like air conditioning or heater. It was like super hot in the summer and super cold. And I would eat really basic food like just eggs and bread. And then I had the same clothes for, gosh knows how long. I'm actually kind of embarrassed to say this, but I used to have to like kind of take clothes without paying for it because, didn't have any money. So not proud of that. And I no longer do that because I'm super, super blessed. But I didn't really have a choice back then. So it was really tough. However, the way compound interest works is life is tough. You go through lots of pain and then you go through, you're a warrior and then you just have such an easier life, at least financially, right? So that's how finances work. If you invest in yourself and stay on this journey, and I truly mean, don't make stupid mistakes. Don't lose money. Don't go off the deep end starting to buy options, following the news, playing earnings. Make sure that you're using covered calls. Yeah, just make sure that you are focused. Then you can get to $1 million. And then after 1 million, it just becomes really easy. You can go to 1.4, 2 million, 2.7, and that's basically the trajectory that I'm currently on. And that's just how compound interest works. So look, please don't cheat yourself. You want to take the integrity route in life. Don't take any shortcuts. Don't cheat. What you want to do is you do not want to aim too high, okay? 35% is already very high for a small portfolio. And then as you go into the future, you are probably not going to be able to even make 35%. Because if you take the difference here, like if I take $56,000 minus the $30,000, you will see that, this is just like $26,000, which a lot of it is just adding. This is basically a reverse mortgage. So if I drag this down, you will see that the returns that I'm making that you can make per year just goes astronomically high as I go into the future. So instead, what I recommend is, yes, you can aim higher at first. I have months all the time that are over 3-4% easily. So let's say this is 48%. And by the way, as you can see, the higher I make it, the more ridiculous the numbers get. And then over a certain period of time, you become richer than anyone in the planet. You'll be richer than Jeff Bezos and Elon Musk if you can continue to compound your wealth by 48%. So don't be naive. You can't do this forever. You have to focus short term to building your portfolio as quickly as possible, of course. But at a certain point, you're not going to be able to do it. So instead, let's just take the return down to 18%, or let's just make it 24%, because that's 2% a month. So let's make it 24%. And let's say that you can no longer make, 48% per year in returns beyond even 667,000. It starts to become, no, you could beyond 1.5 million, I would say. So let's take this formula right here, and I am going to make it right there. So now I will drag this down, and you will see instead of 96 million, 14 million, which is a lot more reasonable. See how the rate of return went from 48 to 24, and the difference was literally 96 million to 14 million. That's like literally $80 million difference. That is for a reason, because compounding your wealth at 48%, as you can tell, is unrealistic. It's not realistic on forever. But here's realistically what your portfolio could look like. So after 10 years, you could be growing your wealth by $317,000. Obviously, you can take out half of that and live pretty good on $150,000. I make a lot more than that. I am somewhere around this area. So I'm somewhere around here. I'm in my 10th year of investing, but I've been able to save more than $12,000. And I've actually personally started to drop my rate of return quite a bit because I really want to be safe. You can actually play around with this and you can adjust your risk and return profile. As you will see later on in this video, I'm going to show you how to basically dial up your risk and make a higher return with spreads, or lower your risk and even do in the money covered calls, or like the double dividend strategy. So if you do the double dividend strategy, that's super safe and it's a lot lower in return. So let's just say, well, this was my goal personally. So I wanted to hit maybe 3 mil, and at 3 mil, even if I make 15%. So at $3 million, if I drag this down from 24% to 15%, let's see, yes. So I'm going to drag this down. So yeah, it's a lot more conservative, although now it's a little too conservative, okay? So I think I'll definitely surpass $7 million in 20 years. Well, that's not 20 years for me because I'm somewhere around here. So what is that, 6 years? I'll probably surpass that. So now that's a little bit too conservative, but obviously I'm being very conservative. I'm not Mr. Aggressive here. I'm not Mr. Day Trader. I'm not your swing trader. I'm not your Forex trader. I'm not your crypto trader. I am your retirement, safe, passive income investor. I think I have the best channel here on YouTube because I focus on consistency. I'm not promising the dream. I have a Discord community, but I'm not out of my way trying to sell it because I don't need it. Only if you want to join, it's the first link in the description. You can get voice notes from me. You can get all my trades. You can get access to me from 9 to 5. All market hours. But again, I'm focused on just delivering value. So as you can see here, the income can be quite high and most people can't even spend this. This is a little bit conservative because I've been making more than these numbers. So this is how you would essentially plan your wealth. And yeah, just shoot me a comment down below. I can share this with you as well.
We know from my prediction that gold will remain within the range of this 25, 20, 24, 40. Okay. If this range is changing, I will give you my indication, my prediction first. And if you go in here, you draw that range here in your trading platform.
Church's Newts in the wraps. Yeah, choose any two starting at $4. Church's.
I'm going to explain why iron condors are a gold mine of an opportunity and how you can make monthly consistent income and grow a small or medium portfolio fast using my specific iron condor strategy in this video. How I open, close, manage, and profit with a lot of detail in between. Listen up, because this is easy money if you finish this video, and I guarantee you it's the best one on YouTube on iron condors. And if you understand what I'm going to tell you, you are going to make money. And if you don't listen to my last management strategy, you are definitely going to have lower profits in this trading strategy. All right, here's Netflix. Netflix is a very interesting setup right now. And if you're watching this in the future, it doesn't really matter. You just have to understand where the stock is currently trading in relation to its history. So look at this Bollinger Band right here. I love Bollinger Bands because it gives me a very good sense of where the stock is likely to trade within based on statistics. Now, Netflix is somewhere in between its Bollinger Band, which makes it the perfect setup right now for an iron condor. Because you see, if it was at the top of its range, that would make it pretty expensive. Now, if it was at the very bottom, like right here, then that could be a signal that this stock is oversold and it might rise. But currently, right now, it's sitting right in between, which is a very strong signal and a very strong setup. Because if a stock has already kind of fallen down from its peak, but it doesn't look like the momentum is going down, that makes it a very good candidate for an iron condor, since an iron condor benefits if the stock continues to move sideways. And something like Netflix right now is moving sideways. You don't have to use Netflix. You can find a different stock. As long as it's going sideways, the iron condor strategy is the best one that you can implement. Choosing the correct strike prices and expiration dates is vital to ensure that the trade has a high probability of success. Properly executing the opening leg sets the foundation for potential profits and it minimizes risk. A lot of people ask me, how do I manage this position correctly? Well, the most important thing that you can do for managing the position correctly is opening the position properly to begin with. If you open an iron condor properly, you have done 90% of the work required. When executed with a disciplined and a precise strategy, the iron condor strategy can provide traders with a reliable stream of monthly income. So let's open this up in my Robinhood portfolio right now, which I do have a link for in the description if you want level 3 access. Now, taking a look at the Netflix trade and Netflix options, okay? What I'm going to do is I'm going to pick an expiration out into the future. Now, check out the chart. I am using the Bollinger Band and it's going out about 20 days. Not about, exactly 20 days. So what I want to do is actually, this is 20 trading days. So I'm going to go out roughly about a month. So that would be August 25th. Again, if you're watching this in the future, it doesn't really matter. You usually want to go out roughly 1 month. You can do weekly option trading and iron condors are a suitable strategy for that. However, for me, I like monthly trading because it's less work It's less management. And if I open up a good position, I can set it and forget it and just have a monthly profit. Now, how will I pick my strike prices? Because this is the most important thing that you can really do. If you pick the correct strike prices, then you don't have a lot to worry about. Even the stock bounces up and down, most likely your iron condor is going to be very profitable. So for example, check out the bottom of the Bollinger Band here is roughly 400 and the top is 482. Now that's very wide, but the good news is that Netflix has a lot of implied volatility. So if I go down and I go to sell put option, and that's how you want to start off an iron condor, want to get started with the puts, you can see here that the $400 strike price right here is still a 21 delta, so not low. And the reason why this delta is not super low, and we'll talk about delta in just a minute, is because the implied volatility here is pretty good. I mean, it's pretty big. 33%, almost 34% is not low. It's not super high, but this is a very good amount of implied volatility, and this is actually going to give you really good premium. So for example, if I go ahead and sell the $400 put option here, now my typical iron condor here is going to be a $5 gap, meaning if I sell 400, I do 395 on the buy. If I sell 390, I do 385 on the buy. Okay, so I like to have a $500 spread. Now you can do $300. You can also do more than that. I just like $500 for many reasons. If you have any questions or preferences yourself for the strikes that you pick, let me know in the comment section below and I will answer. So I have sold the 400. Now I'm going to go ahead and buy the 395. So if I go ahead and buy the 395, this is a put credit spread. Now to actually make an iron condor, I'm going to have to also sell call options, right? I'm going to have to scroll up, and the top of the Bollinger Band, I'll remind you, was around 482. So to be extra safe, I'm going to go ahead and sell the 485 right here. Now you will notice that the delta is going to be lower, and yes, it is lower. I already knew that because I can look at the premium and see that the premium was a lot lower than what we collected here, which was $500. Now we're only collecting $247, which is fine. That is what it is. It's basically based on the Bollinger Band here. Okay, so 485, I'm going to sell that. I'm going to go ahead and buy the 490. And now this is an iron condor. This is actually a short iron condor, and the benefit of a short iron condor is that the stock continues to move sideways. And again, reminding you that Netflix is likely to move sideways based on the technical analysis that I have done my work on. So right here, you can see that you are risking about $350. But again, if it stays in between here, you will be successful in collecting and making $150 per month with just $350. Now look, management is the secret sauce, because you really need to listen to this. It's really easy money if you understand how to manage this position. And I really do look at delta. For example, a high delta is not really good, especially if you're doing a selling strategy. So this is a selling strategy. You know that because we have sold the 485, which is the closer to the money option. What I mean by closer to the money is we're at 427, 485 is closer than 490. So this is a selling strategy because I am betting that Netflix won't rise above.
They've got you.
Of 485, right? So my goal is it doesn't go above 45 because that's where I will start to lose money and potentially go into this red zone. Now on the put side, I want it to not fall below 400. And again, I don't think that is likely. I think Netflix will trade within this range. Okay, but if it falls below 400, then I will start to lose money. For me, I'm always looking for a delta of 0.2 or less. The lower delta you go, the safer this iron condor will be. But of course, if you pick a delta that's super low, like 0.03, 0.05, then it's going to be very safe. But then at the same time, your premium collected will also be very low. So you want to have a very healthy balance of making really good money, but make it consistent. And that's exactly why I pay a lot of attention to how I open an iron condor to begin with. And the iron condor is the fastest way to grow your portfolio because it has both sides. You're selling both the puts and the calls. As long as you get your entry correct, then you are going to be very profitable. And specifically, this is what I focus on in my smaller Discord. I have 2 Discords, and on the smaller Discord, I really focus on spreads. You can actually get a deal for the smaller Discord if you get my book in the description. After you get the book, you actually have a special promotion for the smaller Discord if you want to try it out. Now, speaking about profits in the iron condor strategy come from a combination of time decay and a decrease in implied volatility. So I was just showing you that this option right here had an implied volatility of roughly 35. Now, the higher the implied volatility, the better because the premium is higher. And if you're selling options, high premium is a good thing because that's what you pocket right away as soon as you open up this iron condor. For example, as soon as I open up this trade right here, I will collect $150 immediately into my portfolio. As the options contracts lose value over time, the trader benefits, and if the implied volatility drops, the option premium also declines, leading to more profits. So over time, this option position will decay. You can always buy it back for a profit. However, for me, I like to hold until expiration. Leaving an iron condor alone after opening can be a beneficial strategy. And for me, it's very beneficial for several reasons, primarily related to the strategy's design and, well, the expected outcome under certain market conditions. So the market condition that I want to happen is that the stock continues to move sideways, okay? If the market continues to move sideways, then basically theta right here will continue to kick in and give you more value. So for example, this theta right here is 0.13, meaning about $13 per day. Now, of course, you have some other options here. If I go to the 485, you will see that the theta right here is 0.15. So you're making $15.45 per day. But of course, this one right here is working against you. So if you take the difference of the 15 and the 13, it's about $2 a day, okay, on this side, and probably another, $2 or $3 on this side. So it's basically $5 a day. But the reason why it seems so small is because this option is expiring in 30 days. As it approaches